President and Honorary Secretary of both the associations, to escort the esteemed dignitaries onto the dais. Advocate Samir Siddhapuria sir, CA Jigar Shah sir, Advocate Abhay Desai sir, and Advocate Hardik Modh sir. We welcome you all onto the dais, sir. Let me now take the privilege to introduce Advocate Samir Siddhapuria, sir. Sir has been an editor of Sales Tax Journal for the year 2017-18 and 2018-19 and has authored numerous books on VAT. Sir has been a visiting faculty at Sardar Patel Institute of Public Administration and State Good and Service Tax Department. Sir is an expert in GST, tax planning, providing opinions and appearing in litigation before the various authorities like Honorable Tribunal, Advanced Ruling Authority and Commissioner Appeals. Sir, we are privileged to have you here today amongst us. I would now like to brief you all about CA Jigar Shah. Mr. Jigar is a fellow member of the Institute of Chartered Accountants of India and law graduate from Gujarat University. Mr. Shah has experience of dealing with indirect tax law for more than a decade now. Sir is a member of Committee of Indirect Taxes, Gujarat Chamber of Commerce and Industry since the last 7 years. Sir has rich experience of consulting Indian corporate groups and many MNCs. At present, Sir is working as a partner in MS Lakshmi Kumaran and Siddharan attorneys at their Ahmedabad office. Sir, we heartily welcome you here today. Now I would like to take this opportunity to attempt to introduce Advocate Abhay Desai, sir. Sir, Abhay Desai is an All India rank holder at the CA examination. He has also done his LLB and is a DISA holder. Sir has authored several books, Get Ready for GST and Sabka Vishwas Dispute Resolution Scheme 2019 are a few to name. Sir, Abhay Desai has also addressed more than 350 seminars on indirect taxation till date. He has made representations before the Finance Minister of India as well as the Deputy Finance Minister of India on various issues under the GST. Sir, Abhay Desai is a board member of an NGO based in New Delhi and is an advisor to Fortune 500 companies as well as large number of listed companies in the field of indirect taxation. Sir has been awarded as the best column writer by the Gujarat Sales Tax Bar Association and he is also a brain trustee in all Gujarat seminar by the Bar Association. Sir, we are honored to have you here today. Yes, the long list definitely deserves a big round of applause. Let me now introduce Advocate Hardik Modh, sir. Sir is working as a partner in economic laws practice since March 2007, having offices at Mumbai, Delhi, Ahmedabad, Pune, Bangalore and Chennai and having strength of more than 2,000 advocates. Sir has also been invited as a speaker by various associations and institutions like Income Tax Bar Association, Institute of Chartered Accountant, Gujarat Sales Tax Bar Association, Tax Bar Association and Tax Advocate Association. So we are honored to have you also amongst us today. I would now request to welcome all the dignitaries on the dais with the memento and a book. Advocate Abhay Sheth, sir. Abhay Sheth, sir, please come forward. Okay. I would now request Honorary Secretary Bal Mukund Shah, sir, to please come ahead and felicitate Advocate Abhay Desai, sir, with a book and a memento. It's a big round of applause for Abhay Desai, sir. I now request Advocate Ashutosh Thakkar, sir, to please come forward to felicitate CA Jigar Shah, sir. I now request Advocate Mrudang Vakil, sir, to please come forward on the dais and felicitate Advocate Hardik Modh, sir. I request Advocate Bharat Sheth, sir, to please come forward to felicitate Advocate Samir Siddhapuria, sir. We now open the floor for the question and answer round. Sir, the dais is all yours.
Can we start? Serial number wise. So, a very warm good afternoon. First and foremost, I am grateful to both the associations, that is All Gujarat Federation of Tax Consultants as well as the Income Tax Bar Association of Ahmedabad, for inviting us and allowing us to share our views on the issues concerning indirect taxes. Now, without wasting much time, let me take up the first poser. So, I am sure you would have read the facts. So, he is a wealthy chartered accountant, Mr. Rahul. Rahul name often reminds us about many qualities, but this is a chartered accountant who is a wealthy chartered accountant. So he has an office in Mumbai and Cochin, and he has 2 flats in Delhi, which he has rented out to a lawyer under lease deeds. One of the flat is fully used by the lawyer as an office, and another flat is used as a residence, although as it happens with a lawyer, there is always a room within the residential premises which is used to store the court files. Now Rahul is of the view that he should charge IGST on the lease amount that he recovers from the lawyer. The chartered accountant of Rahul is of the view that no, in this situation he should register in Delhi and charge the Delhi state GST and the central GST. And therefore Rahul should also obtain the registration. Lawyer in fact is of the view that no GST should be charged at all on flat A because legal services are exempt, and on flat B because it is used for residential purposes. So we have 2 major issues to understand and deal with. One is, what is the nature of supply? Is it an interstate supply happening from Maharashtra, that is where Mr. Rahul is based, to Delhi where the property is located which is given on rent, or is it an intrastate supply for which he requires a registration in Delhi and he is required to then charge the applicable state GST and the central GST. Second issue is, once we determine the nature of supply, then second issue is whether that supply is taxable or exempt qua both the flats, whether in case of flat A, which is used by the lawyer for official purpose, will it attract GST, and flat B, which is used for residential purpose, but it has an additional room within that flat where the lawyer is storing his case files. So with this background, let us try and understand both the issues. So when we talk about requirement, and this is a very common issue, although these facts happen in the case of a chartered accountant and a lawyer, but this is a very common issue where some of your clients also would be having properties in other states. And a question always arises that if those properties are given on rent, whether a registration should be obtained in that state and whether the state GST and the CGST should be charged, or whether billing can be done from Ahmedabad, leaving IGST on the rental income. Now first let us see the scheme of the Act. So when you look at section 22, subsection 1 of the CGST Act, it says a person is required to register in the state from where he makes a taxable supply. Now when you look at the definition of the location of supplier of services, which is given under clause 71 of section 2, it identifies 4 locations which can be considered as a location of the supplier of services. The first is where a supply is made from a place for which registration has been obtained. It is considered as the location. That is where he has already obtained a registration, and from where he is making a supply, that place of business is considered as a location of supplier. If supply is made from a place for which registration has not been obtained, then the law says that fixed establishment would be considered as the location of supplier. Where supply is made from more than one location, the law says the location which is more directly concerned with the supply would be considered as the location of supplier. And last is if location cannot be identified under any of the 3 clauses that we discussed, then the usual place of residence would be considered as the location of supplier. The law defines what is fixed establishment, the law defines what is place of business, and law defines what is usual place of residence for all the 4 clauses that we have discussed. Now, without getting into more details, if you see the scheme of the Act, when you examine the definition of place of business, fixed establishment, you will find that it connotes a location where some activity is performed by the supplier qua the supply in question. When you see the definition of fixed establishment, it says that establishment should have technical resources, it should have human resources to be in a position to make a supply or to receive the supply. When you look at the definition of place of business, it also gives an illustrative list where all the places are of nature where some activity is undertaken by the supplier in question. If it is a godown, he is storing some goods there. If it is a factory, it is a place where he is manufacturing the goods. So the scheme of the Act is like this, that law considers the location of supplier qua supply based on the nature of activity performed by the supplier from that location. Now, when it comes to giving property on rent, it is a simple transaction where the property in Delhi is given out on rent by an owner in Mumbai. At the property, the owner is not performing any activity. The owner is not even situated at that property. It is only executing a rent agreement. Based on that rent agreement, the tenant is occupying the premises and enjoying the possession of that premises for a certain duration. So to my mind, considering the scheme of the Act, the location of supplier of services can never be Delhi in such facts. It has to be always Mumbai from where he is operating, but this would, to my mind, fall into the last category, usual place of residence. In this case, since it is an individual, Mr. Rahul, so usual place of residence is Mumbai, and therefore that should be the location of supplier. Once we have identified the location of supplier, then the place of supply in case of an immovable property, services which are directly related to immovable property, you are aware under section 12(3), it is the place where the property is actually situated, which in this case is Delhi. Since both the places, that is Maharashtra and Delhi, they are different states, so it would be considered as an interstate supply and under section 7 of the IGST Act, and therefore IGST should be leviable on this transaction. In fact, one can also take recourse to the law which has already been developed in UK, because we have a similar, in UK, there is a similar provision consisting of the definition of fixed establishment and the place of business. In light of that definition, what the UK courts have hold, they are saying that property by itself does not create a fixed establishment. As I discussed, our scheme of the Act is also that mere existence of property does not mean that that becomes the location from where some supply has happened. You need to have some resources at that property which are engaged in making the supply for which you want to determine the nature of supply, that is whether it is an interstate supply or an intrastate supply. So in UK, the law is well settled. One can see the decision in the case of Titanium Limited, where the courts have consistently held in that country that mere existence of property in other state would not tantamount to having a place of business in that state requiring the registration or the payment of tax. Courts in UK are also saying that, let us say, if in Delhi Mr. Rahul has opened a branch office because he has many properties, these are only 2 properties, it is possible he may have 20 properties. Now to manage those 20 properties, if he opens a branch office where there is a staff situated at that office, prospective tenants meet the staff, staff explains the benefits of the property, negotiates the rate, and actually then rents out the property, then it can happen that the location of supplier may happen in Delhi. For that reason, he may have to take a registration in Delhi and then discharge the state GST and the CGST of Delhi. Now, foreign judgments, one always says that what foreign judgments has to do when it comes to Indian law. But where the law is similar, even Indian courts have held. You can refer to the Supreme Court decision in the case of Conship Container Lines, that is 297 ELT 321, where Supreme Court has held that if the law is similar, then one can adopt the principle adopted by the English courts in our context. So as far as first question is concerned, I would say that it would be an interstate supply. Mr. Rahul does not require a registration in Delhi. Rahul can operate from Maharashtra. Now second question. Citation 297 ELT 321. ELT. EE. Elephant ELT.
Excise law type.
321. Now coming to the second question of exemption. Now lawyer as always is adventurous, because the lawyer is saying that even in respect of flat A, since he is using it as an office, it should be considered as a legal service and therefore it should not be liable to tax. To my mind, this argument would fail, because the law defines what is a legal service. It is a service which is governed under the Advocates Act. It is a representation service, litigation services. Renting services can never come within the ambit of legal services. So to that extent, the view of the lawyer is incorrect to say that flat A would not be liable to tax. GST would be applicable on the rental amount of flat A. Now when we go to flat B, issue becomes interesting, because in flat B, it is for a residential use with a condition that one room in that flat is allowed for keeping the files of the court by the lawyer. When you see the exemption notification, entry 12 of notification 12 by 2017, it says services by way of renting of residential dwelling for use as residence, except where residential dwelling is rented to a registered person. So only where a residential dwelling is rented to a registered person, it becomes taxable. This is the law after the amendment that happened in July 2021. So this we are discussing the current law, which says that renting of residential dwelling for use as residence is not unconditionally exempt, which was the case prior to July 21. Now it is exempt except in a situation where residential dwelling is rented to a registered person. So if it is rented to a registered person, then registered person is then liable to pay tax under the reverse charge mechanism. Here we are assuming this lawyer is not registered, because under law, if the lawyer is rendering exclusively services which are falling under reverse charge mechanism, he is not obliged to register even if the turnover exceeds 20 lakhs. So with that presumption, we have to then examine whether exemption can apply to these facts. Now a close reading of this entry suggests that what is exempt is services by way of renting of residential dwelling for use as residence. So the test, for what purpose the residential dwelling has been rented out. Is it for use as residence or otherwise? Now, in such situation, to my mind, when the permitted use is for residence, but the tenant also makes a part commercial use of that property, if the primary purpose remains as residence, then according to the primary purpose, the notification is required to be interpreted. So we have a decision of Supreme Court in the case of Annapurna Carbon Industries, 37 STC 378, where in the context of goods, where the dispute before the court was, there was certain goods which had a primary purpose and which also had a secondary purpose. And instances happened when certain customers were making the use of those goods for secondary purposes. Department wanted to classify the goods based on the secondary purpose and not on the primary purpose. Supreme Court said that no, a classification in such situation would be driven by the primary purpose, not by the secondary purpose. In fact, in the case of specifically lawyers, there is already a judgment of Calcutta High Court in case of Arup Sarkar, where the Calcutta High Court in the context of land related dispute have held that as a lawyer, if he is using as a residence, But given the fact, the way the lawyer practices his profession, it is quite possible that certain room in that premises, he may use it to store his files or meet the clients, but that by itself would not invite the tax on the property based on characterization as a commercial property. It will remain as a residential property. It would not become a commercial property. So the tax, the local tax, would be based on what is the amount applicable for residential property, not what is applicable to commercial property. So even that proposition can be borrowed here to say that if the local authorities are also charging the tax on that property, considering it as a residential property, the primary purpose is also of use as residence, then this exemption notification would be applicable, and therefore, to the extent of flat B, GST would not be payable. So to summarize, the supply would be an interstate supply happening from Maharashtra to Delhi. Flat A given for use as office, taxable. Flat B given for use as residence, although a part of that premises is used for storing the court files, would not make it as a non-residential use. It would remain as a residential use, and therefore the exemption would be applicable and GST would not be leviable as far as the second flat is concerned. So I think this addresses both the issues.
Thank you. The second poser is very simple in a sense. Now it's settled also. I will explain. Like say for example, you are an SSE. At the relevant time, you are registered under Central Excise or Service Tax. Now in a Senvet credit rule scheme, there were certain services or the goods also that which were not otherwise eligible for taking the Senvet credit. Now let's take an example. In 2013, you availed the Senvet credit of construction services which was otherwise not eligible to you. You have not utilized that credit somehow. In 2017 when GST came, you transferred all this credit to GST regime through Tran 1 and this credit also got transferred. Now in 2020, 2021, some assessing officer is now scrutinizing your Tran 1 credit and he now realizes that whatever the Senvet credit you availed and carried forward in GST regime, that Senvet credit itself was not eligible to you. But the fact is at the relevant point of time, if suppose he would have found out that this is an ineligible credit, then he would have taken an action under Rule 14 of the Senvet credit rules for recovery. That action has not been taken. We can also discuss a situation where such action is also taken, litigation is pending, still the SSE carried forward the credit. Now, so far as any recovery under the GST is concerned, there are only two sections. Section 73 and 74, under which are the provisions under which the recovery can be made is non-payment of tax, short payment of tax, tax erroneously refunded to the SSE, input tax credit wrongly availed, and input tax credit wrongly utilized. So Parliament is conscious in using these 5 different phrases. Somebody can say that since you have availed and utilized the wrong credit, it will amount to short payment or non-payment of tax. But if it was so, then there was no need for the Parliament to use these different 5 phases. Okay? Each of them is different in operation. So if I avail the wrongly not eligible credit, utilize that. It is not equal to tax not paid or short paid. Because Parliament is conscious in using these 5 phrases differently. It says that tax not paid, tax short paid, okay? Tax erroneously refunded, input tax credit wrongly utilized, and input tax credit wrongly availed. These are 5 different scenarios. So they are not same. What has happened in this case? Some credit was not eligible, SSE carried forward, come into Tran 1, and now it is utilized. The claim of the assessing officer is that under section 174 repeal and saving, we can take some action under the GST law also for the past period. But it is not so. What section 174 says, that suppose if you were otherwise eligible to launch a investigation or issue a show cause notice against the SSE, even after this act is repealed, you can do so within the permissible time limit. Here what has happened, I took the credit in 2013. So in the service tax or excise regime, the assessing officer would have time for 5 years from the date of taking this credit. So that has expired. Section 174 is not a provision where you have missed one bus, now you can catch the another one. It cannot happen. Otherwise, what will happen? That if suppose the assessing officer alleges suppression on your part, the credit which you took in 2012, somebody will issue a notice in 2025. That since I have a power because you have transitioned in 2017, therefore I will issue the notice for a 2017-18 in 2025. That cannot happen. So otherwise it will be endless. So that is not the purpose of section 174. This similar issue occurred in a case of this Usha Martin's case. Jharkhand High Court, I will give the citation. 2023, 68 GSTL 338 Jharkhand. Okay. And there is another judgment which also we will discuss is a commercial steel 2019, 28 GSTL 579 Patna. So you will be wondering what Patna and Jharkhand High Court decisions we are discussing, but that's a fact. These are the good decisions from Jharkhand and Patna. The case before Usha Martin, before the Jharkhand High Court was also same. SSC was already litigating some input services credit. Show cause notice were issued, some are pending before the C state also. Balance was there, SSC transitioned this credit into GST regime and utilize also. So the revenue said that under 174, I am eligible to issue show cause notice to you, therefore he issued a show cause notice. Jharkhand High Court says that section 73 and 74 have a limited application. It says that what can be recovered? Input tax credit wrongly availed and input tax credit wrongly utilized. Now if you look at the meaning of input tax, under the GST law, it says that tax under the CGST, SGST, UTGST, all are input tax. And input tax credit is tax of the credit of input tax. That is how the simple meaning in 262 and 263 of the CGST Act gives. It says that therefore, the assessing officer has no power to recover anything which has been transitioned in Tran 1. It's a very broad proposition laid down by the court. And if you look at paragraph 19 and 20 of this, the court though this was not an issue before the court discusses this. Court says, now let us take an example, the SSC has really transitioned the wrongly availed credit, which was otherwise he was not eligible to. There also the court says that that credit cannot be disturbed, that cannot be recovered because you don't have a power under section 73. So therefore, I started with this. When the section says input the tax short paid, tax not paid is not equivalent to input tax credit wrongly availed and utilized. Otherwise, there was no need for Parliament to use these different 5 phrases. Okay. So therefore, these are all different. So two proposition. Once credit, even in wrongly transition in Tran 1, the revenue has no power to initiate recovery proceeding under 73-74. Another proposition is 174 is not the bus you can catch once you have missed the already won the original one. Otherwise, there will not be any time limit on this. 174 is only empowering the assessing officer that if otherwise you are entitled to, within the legal framework, that within the 5 years from the relevant date, you issue the show cause notice for the recovery of the Senvet credit rules, not under this. And you look at the language, the point they have missed in drafting in CGST Act is, Rule 14 of the Senvet credit rules deals with recovery of wrongly availed credit, availed and utilized credit. There was a Central Excise Act. In a parent legislation, you will see the provisions for a recovery of excise duty. Section 11A will not say that a recovery of the Senvet credit. It will not use that word because the excise law is not meant for that. Excise law can recover the excise duty. Similarly, Finance Act 1994 service tax provisions, Section 73 will not say that I will recover the Senvet credit. If you look at the Section 73 in Finance Act 1994, it says that tax not paid, short paid or erroneously refunded. These are the 3 phrases used in that section. Why so? Because Senvet credit rules were a subordinate legislation under both this act. Section 37 of the Central Excise Act empowered the government to frame rules for giving the credit. But Rule 14 of the Senvet credit rules contain a phrase, it says that whatever the power, because under section 11A you can recover the central excise duty. Under section 73 of the Finance Act you can recover the service tax. You cannot recover the wrongly availed Senvet credit. So Rule 14 says that whatever the provisions are of section 11A of the Central Excise Act and section 73 of the Finance Act shall apply mutatis mutandis to Rule 14 also. So by using these words mutatis mutandis, they adopted the power for a recovery of this NVAT credit under the excise and service tax. Otherwise, that was also not possible. Here, there is no such as mutatis mutandis. Somebody also can argue that if you, on a one hand, you say that transitional credit is not an input tax credit under these Act, and transitional credit is not mentioned in the recovery section at all. 73-74 does not deal with recovery of transition credit. There is no word like transition credit. So that cannot be recovered. Somebody can argue that on a one hand you say that this, whatever the credit you have transitioned is not an input tax credit, but you have utilized that credit against your liability. So against your liability, what can be utilized? Input tax credit only. When you have to discharge your GST liability, you are utilizing the input tax credit. There happily you are saying that this is nothing but an input tax credit. There the legal answer is this. If you look at section 49(4) of the CGST Act, which says that how you can utilize your input tax credit ledger, electronic credit ledger, it does not uses the word input tax credit available in your electronic credit ledger. It uses the word amount available in your electronic credit ledger. Now amount and input tax credit are two different things. It's not the same. So transition credit now given to me as an amount available in my electronic credit ledger, which I utilized. So there also I have not made any default. So nothing will happen. So this is how whatever the credit, now many of you will be facing this issue that some credit they will say that you have wrongly transitioned. This was not eligible to you. But these two judgments will help you. Usha Martin is very substantive. In commercial steel, the facts are slightly different, but that is what the proposition has been laid down. In commercial steel, SSE availed the credit but not utilized. In Usha Martin, availed and utilized, then also court says that you don't have power to recover under the GST law. So till the time they amend this law retrospective effect, this will hold the field and no recovery can be made. But Patna High Court? Yeah, well, I will give you both. No problem, sir. Usha Martin, 2023, 68 GSTL 338 Jharkhand. 338, yes sir. Another one is a commercial steel. Commercial steel, that is 2019, 28 GSTL 579 Patna. So these two judgments will be helpful to you. Huh? 579, yes. Yep, that's all.
Good evening to all. Before just I give answer to my question, I would like to thank to the President as well as Secretary and Committee members of All Gujarat Federation Tax Consultant as well as Income Tax Bar Association Ahmedabad for giving me this opportunity. So I'll just share my answer related to the first my question. No doubt it is running serial number wise 3, but it is my first question. So it is related to input service tax distributor as well as the cross charges. And now this concept has come up and it has now been every time when there is a common input or common input services, this question arises, whether do I require to distribute this credit among all my units located in a different states, to whether can instead of ISD, can I go for cross charges or not? So let I now put my questions and then I define, then we'll discuss what is the meaning of ISD as well as cross charges. This is a case where one of the company has a registered office in Ahmedabad and engage in the consumer products, fast moving items like wheat, flours, rice and all these items. They have sales depot across India in a different states. No doubt they have not started all the depot immediately. Gradually, some of those depot they have already started and some of them depot they are going to start in a periodical time. They purchased one brand, one of the reputed brand from the foreign company. the agreement with them, with the registered office in India, that yes, this brand is now irrevocably transferred to Indian company, Indian registered company. Two, it is a perpetual. And third, as per their wish, they can use anywhere. Now question arises, no doubt before that, Indian company registered office in Gujarat, they paid IGST under reverse charge mechanism on this brand, on this trademark or the brand name. Now the question arises that whether this the IGST which has been paid under reverse charge mechanism is required to be distributed among all the states or not, wherever they have registered. Two, whether in case of they don't go for ISD, whether do they have option to cross charge to their different brand or not, to different branches or not. Third, question is that instead of either distributing to the different branch or go for cross charges, whether registered office can themselves avail this credit and use for their own output supply or not. So this is the three questions, and now I put in a different way because this is a commercial. Now how we can understand this query in our language, as a lawyer language, as a consultant language. That chartered accountant or lawyer, they have different branches across India. They avail some common services, or they avail one particular services at a main office. They require to distribute among different states, or they require to cross charge it different the state or not. What is meaning of ISD first? It has been defined under the CGST Act that ISD means full form is the input service distribution. That means the taxable, the service provider or the supplier of the goods or services, they receive some input services under the tax invoice issued under section 31 and distribute this credit among their own units having the same permanent account number, that is called as an input service distributor. Meaning thereby that I have office, I purchase this brand, I avail the credit, now I require to distribute among different states, then I am an input service distributor. First question, whether is it compulsory for me to distribute? The answer is no. It is not required to distribute compulsory. Why it is not required? If you read the section 20 subsection 2, the word use the may, not shall. Hence, what is happened that if registered office under reverse charge mechanism paid IGST on this brand and avail the credit, then it is up to him whether he wants to distribute or not, because the word may is used. Now this identical provision was there under the Senate credit rules. In Senate credit rule before 1st April 2016, the word may was used, and in that context, the Bombay High Court in the case of Oricon Baser Coating India Private Limited, they said that since the word may has been used in the under this rule, and therefore it is not a compulsion for distribute of the credit, and hence from 1st April 2016 onwards, the legislature replaced the word with shall, and therefore from 1st April 2016 onwards, it was a compulsion for the distributor to distribute the credit. So that is in the case of the ISD. So it is not compulsory for them. They can definitely avail the credit. They can definitely use for their own purposes. Now second question is regarding the cross charges. What is a cross charge? Actually, it is not defined under the GST Act. But this concept has been evolved based on the section 25 definition that when the one company or one registered person having the PAN number have different registration in the different places. In that context, they require to take the separate registrations. Under Schedule 1, they says that any transaction happen between the related person, even without consideration, then it is required to, it is considered as a supply and required to pay tax on it. So, in case one registered office or one branch provide any supply or they supply any material or goods into the other state, they require to pay the GST on this transaction even though there is no consideration. And hence, this cross charges concept came, and particularly in the case when company registered office employee are transferred to branch, or they avail one services which is, they supply their services to the other branch. In that cases, they require to raise the invoices and they require to charge GST on it. Now, question here arises that registered office who procured this brand with hefty amount and paid GST on reverse charge, is it compulsion for them to charge this GST or based on the locations? It depends on answer how you draft the agreement. If the agreement drafted in a particular way that yes, it has to be required, it is required to be used by other and it is required to be paid consideration, or in a other way that yes, different branches can use this brand, in that situation, yes, in case of the cross charges, GST has to be paid. In the present case, the agreement was drafted in such a way that registered office, they had entered into agreement with the foreign company to register office consideration. And third, the agreement itself says that the registered or this company itself use this brand, meaning thereby it has not been specified location wise, and therefore it has been, we can opine or we can come to the conclusion that since it has been for the entire company, so whoever use this brand, it is a liberty for them to put that mark and sell the product, and therefore it is not compulsion for them to cross charge it. And it is not compulsion that for the registered office to distribute to distribute this credit, and two, it required to cross charge in respect of the other places. Yes, thank you.
હેલો ગુડ ઇવનિંગ એવરીવન. મારો જે પ્રશ્ન છે એ રિકવરી ઓફ ધી ડેમેજીસ ઓફ ધી એસેટ ઓફ ધી કંપનીની ઘણી બધી વાર એસેટ્સ હોય છે. એ એસેટ્સ પરમાં કોઈ પણ ડેમેજીસ કોઈ એમ્પ્લોયીથી થાય તો કંપની એ એમ્પ્લોયી પાસેથી એની અમાઉન્ટ રિકવર કરે છે ને એ રિકવરીને પ્રોફિટ એન્ડ લોસ એકાઉન્ટમાં અધર રિકવરીના હેડમાં બતાવે છે. નાવ ઇન ધેટ સિનારીઓ કે એ જે ઇન્કમ અધર રિકવરી તરીકે બતાવી છે તો એ અધર રિકવરી અત્યારે તો જીએસટીમાં કેવું છે કે કોઈ પણ ઇન્કમ હોય એને ગમે તે રીતે મારી થથાડીને સપ્લાયના સ્કોપમાં લાવવાની કોશિશ અસેસિંગ ઓથોરિટી કરે છે. સો એ સિનારીઓમાં આપણે આવી જે ઇન્કમ અધર રિકવરી અધર ઇન્કમના હેડમાં જે નાખી છે તો એના પર જીએસટીની ટેક્સેબિલિટીનો ક્વેશ્ચન ઉપસ્થિત થાય તો આપણે એમાં શું કોલ લઈ શકીએ? બેઝિકલી કોઈ પણ એસેટને કંપનીની એસેટને નુકસાન પહોંચે અને એ નુકસાની પેટે કોઈ પણ રિકવરી કરવામાં આવે તો લિક્વિડિટી ડેમેજીસ ચાર્જીસ કહેવાય એને. અને એ લિક્વિડિટી ડેમેજીસ ચાર્જીસ પર સે જીએસટી લાગવા પાત્ર જ નથી, કારણ કે there is no supply of service from the company to respective person, but still ડિપાર્ટમેન્ટ એને ઘણું બધું ડિસ્પ્યુટ્સ કરે છે અને એ ડિસ્પ્યુટ રિલેટેડ આવી એસેટનું જ્યારે પણ કોઈ રિકવરી કરવામાં આવી હોય તો સર્ક્યુલર નંબર 178માં એનું ક્લેરિફિકેશન આપવામાં આવ્યું છે. એ જે સર્ક્યુલર છે એ ઇસ્પો ફેક્ટો મારા જે પ્રશ્નો છે એ આની ક્વેશ્ચન આ જે એફએક્યુ છે એની અંદર છપાઈ જ ગયા છે. તો આખો સર્ક્યુલરની જે રિલેવન્ટ પેરેગ્રાફ છે 178 નંબરનો, એ 178 નંબરના સર્ક્યુલરની અંદર લિક્વિડિટી ડેમેજીસ ચાર્જીસ માટે એક ઓબ્ઝર્વેશન મૂક્યું છે. એ ઓબ્ઝર્વેશન મુજબ જો લિક્વિડિટી ડેમેજીસ ચાર્જીસ અંડર કોન્ટ્રાક્ટ રિકવરેબલ હશે તો જીએસટી ડિપાર્ટમેન્ટ એને ટેક્સેબલ ટ્રીટ કરશે, પણ અનકોન્ટ્રાક્ચ્યુઅલ હોય એટલે કોઈ પણ કોન્ટ્રાક્ટ કોઈ પ્રકારનો થયો નથી અને એ રિકવરી કરી હોય તો એ રિકવરી પર ટેક્સ લાગશે નહીં. વધારેમાં આ સર્ક્યુલરમાં એવું પણ કહ્યું છે કે જો પ્રિન્સિપલ સપ્લાય એક્ઝેમ્પ્ટ હશે તો તમે આવી કોઈ પણ રિકવરી કરી હશે તો એ રિકવરી પર જીએસટી લાગશે નહીં. દેન ધી સેકન્ડ પ્રોઝર જે છે એ જ ક્વેશ્ચનની અંદર સેકન્ડ પ્રોઝર છે એક્સેસ યુઝેસ ઓફ ધી સર્વિસીસ. કોઈ પણ એમ્પ્લોયીને કંપની જે કંઈ પણ એ સર્વિસીસ યુટિલાઇઝ ઓન બિહાફ ઓફ કંપનીના કામ કરવા માટે લેટ છે ફોન માટે એને કીધું હોય કે ભાઈ તને 500 MB કે 1000 MB સુધીના ડેટા કંપની તરફથી આપવામાં આવશે અને એ 1500 MB યુઝ કરે અને વધારાનું પેમેન્ટ એ કોઈ પણ સેલ્યુલર કંપનીને ને આ બધી કંપનીને પે કરે છે, તો એ સિનારીઓમાં એ જે વધારાનું કંપનીએ પે કરવા પડે છે એના બિહાફમાં, તો એ જે વધારાના એક્સેસ યુઝેજ છે એની જે લિમિટ આપી હોય એ લિમિટ કરતાં જે પણ વધારાના યુઝેજ કરે છે એની રિકવરી એ એમ્પ્લોયી પાસે કરે છે, તો એ વધારાના યુઝેજની રિકવરી પર ને અધર ઇન્કમને સપ્લાય ઇન ધ હેન્ડ્સ ઓફ કંપની ગણાય કે ના ગણાય. તો એ સિનારીઓમાં વી કેન વેરી વેલ ટેક અ સ્ટેન્ડ, ઇટ્સ અ રીએમ્બર્સમેન્ટ. જે એણે વાપર્યું છે એના પર ઓલરેડી GST લાગી ગયો છે અને ફરીથી સેકન્ડ ટાઈમ કંપની એ ઇન્કમ કંપનીની ઇન્કમ અધર ઇન્કમ ટ્રીટ થઈને એને સપ્લાય ટ્રીટ ના થવી જોઈએ. ઇટ્સ અ નો સપ્લાય ટ્રાન્ઝેક્શન. થેન્ક યુ વેરી મચ.
So question number 5, basically the facts are that this is an airline, and as you are all aware, airline requires crew and it requires crew members to be looking attractive. So certainly if a person suffers from a hair loss, male or female, certainly the airline would take some steps to remedy that situation. So in this case, the airline has entered into an agreement with a hospital, where under the agreement the hospital is required to do the hair transplant or the hair loss treatment service. Question is that whether this will attract GST, and one of the view is of the airline is that this is exempt from GST, so they are asking the hospital not to charge GST. On the contrary, the hospital is saying that this will attract GST, but airline can avail the input tax credit. So both are trying to have a kind of a divergence. So now they are asking us that what should be the view. There is also additional poser where they are saying that 2 of the employees of the airline have a hair loss because of a birth defect, and if a treatment is undertaken in this situation, then whether GST would be applicable on that treatment. Why this is important? Because every hospital, normal belief is that all the services provided by hospitals are exempt, but that is not the case. So to highlight that aspect, we have chosen this particular case study as a situation. There are many situations, of course, beyond this, where hospitals may be wrongly claiming the exemption. But you will understand from this answer why that is so. So if you look at the law, Section 9(1) creates a levy on all kinds of supply. By virtue of Section 11(1), the government has issued notification exempting certain supplies from tax. So unless your supply falls under that exemption notification, it would otherwise be attracting the GST. Then when you look at exemption notification, in the case of services 11/2017, if you go to serial number 74, what it says, services by way of A, healthcare services by a clinical establishment, an authorized medical practitioner or paramedics. So 2 factors are relevant. One is it should be in the nature of healthcare service, and it should be supplied by a clinical establishment. Law defines both these terms, what is healthcare and what is a clinical establishment. The definition of clinical establishment includes a hospital. So that is now not the dispute here, because the facts are the hair loss treatment would be undertaken by the hospital. So hospital qualifies as a clinical establishment. Dispute is whether is it a healthcare service, because as I said, both the conditions have to be satisfied to claim the exemption. It should be a clinical establishment and service should be in the nature of healthcare service. If you see the definition of healthcare service in this notification, it is very wide enough. It says any service by way of diagnosis or treatment or care. So not just only treatment is covered, even diagnosis services or even post-treatment care services are also within the ambit of this definition of healthcare services. So diagnosis, treatment or care for illness, injury, deformity, abnormality or pregnancy in any recognized system of medicine in India, and includes services by way of transportation of patient to and from a clinical establishment. Now what is relevant for us is, but does not include hair transplant or cosmetic or plastic surgery. So definition is saying healthcare services will not include hair transplant, cosmetic or plastic surgery. again creates an exception to the exception, meaning thereby that now what I am going to read would be part of the healthcare service, except when undertaken to restore or to reconstruct anatomy or functions of body affected due to congenital defects, that is birth defects, developmental abnormalities, injury or trauma. So in a way what they are saying that healthcare services excludes hair transplant. But if hair transplant is undertaken because of a birth defect or because of developmental abnormalities or injury or trauma, then it would again fall within the ambit of healthcare service and it would enjoy the exemption. Now, facts are indicating that because of COVID, the crew members are having hair loss. In fact, this applies to consultants also, that because of GST, we are all suffering because of, we are all going through hair loss. But in any case, so this is a case where because of COVID, hair loss is happening. Now, one has to understand first whether hair is part of body, because the exception, as I read, includes what is healthcare service, any activity undertaken to restore or reconstruct anatomy or functions of body affected due to birth defect or trauma. So two aspects have to be seen, whether hair is body, and second, whether COVID can be considered as an event triggering trauma. If answer is yes, then it will fall within the exclusion of the hair transplant and therefore it will then fall into the exemption net. Now look at body. Body is not defined in GST law. If you look at the dictionary definition, the medical dictionary says hair forms part of the integumentary system, which is an organ system which consists of skin, hair, nails, which is first defense of the body against the outside agents. So be it bacteria or be it protection from sunlight, this acts as a first defense for the body. So medical dictionary considers hair as part of body, number one. Trauma. Now, there is enough evidence now available online which is suggesting that COVID is causing trauma resulting into hair loss. It is now recognized as one of the factor leading to hair loss. So, to my mind, the airline is right in saying that hospitals should not charge GST because this will qualify for exemption. Birth defect, it is already expressly considered in the definition of healthcare service and therefore that certainly would enjoy the exemption. So to my mind, these services should be exempt, it should not be liable to tax. Contrary view, what the hospital is saying that will charge GST, you avail the credit. Now in that situation the airline will have a problem. Although the rate of 5% restricts only credit in respect of inputs, this is an input service. So on that situation, problem would not be faced. The problem would be faced because of 17.5, block credit. Under 17.5, under B, clause B, subclause I, what is restricted is health service. It says law says credit in respect of health services is not permitted. Now can the officer say that because of this ground, I am denying the credit? To my mind, this will contradict the basic exemption itself. Because once we say it is not a health service and therefore it attracts GST, then for the purpose of ITC restriction, it cannot then be considered as a health service so as to deny ITC. I hope you are getting the point. For exemption, if it is not a health service, then for block credit, it cannot be a health service. If it is a health service for exemption, then the question of availment of ITC will never arise because that would not at all attract GST. So on both the grounds, I would say GST, these services should not be liable to tax, and therefore in this situation the airline is right in asking the hospital not to charge. Before I end, why I picked up this question is that similar situations are also there where one has to carefully examine the definition of healthcare service. One cannot go just by the fact that since it is a clinical establishment. In fact, 2 days back only one case came to us where one clinical establishment is engaged in providing supply of manpower services like nurses to various companies. Now that would not qualify as a healthcare service, although it is done by a hospital which is a clinical establishment. So that is why many, if you see the balance sheet of hospitals, you will find many such incomes which may not fall within the ambit of healthcare services. So both the conditions are required to be met. Only then the exemption can be enjoyed. Thanks.
Just to update, and I was sharing with Abhay, day before yesterday, we are in Ahmedabad, we have one legendary plastic surgeon, Dr. Sanjeev Vasa. So his own personal matter for service tax was listed before CSTAT Ahmedabad, and he himself came to court and he was explaining that what is this surgery is all about. So the funny situation for the spectators like me was one member of the tribunal was having a full hair on his head and another was completely bald. So the member having a full hair was asking so many questions. He said that how this pattern works, and he was saying that how do you do this transplantation? Then he said that sir, I have developed not less than 10 patents on hair transplant, and he said that he is the pioneer in hair transplant surgery across the globe. And all this, whatever the research he has done, he has trained so many doctors on this transplantation surgery. And he said that I have not charged a single rupee for this patent. It's only for the use of human beings. And he explained that this is nothing but a deformity. So he said that in a male, the pattern is that this hair will never go. So what they do is they pick from these hairs and transplant in a way. So the question from the bench was that once you pick up the hair from here, so here there will be empty space and you will transplant it here. So how this is going to benefit the patient? Then he explained that it's a skill of a doctor, that how the hairs to be picked up from here and then transplant here, that in a way the minimal transplantation, it looks that your head is full of hair. That is how he explained. And the craziness of this department is wonderful. Few months back, they initiated the investigation on this IVF clinic. According to them, IVF treatment is also not a healthcare treatment. They say that once the pregnancy occurs, then only the healthcare treatment starts. So whatever you do for this holding this pregnancy is also not a healthcare service. So ultimately the GST Council has to clarify that IVF is also covered under healthcare services. And so far as this bariatric surgery is concerned, what do they do? They also do this obesity surgery. So that is also, it's not a plastic surgery or for a better look of the person, but that is also for it's like some deformity, they are really restoring it. So that is, and Delhi Tribunal has held in case of this Mohawk bariatric surgery, they say that this is also healthcare services and it cannot be considered as a cosmetic surgery. Generally this type of problem will occur like in a dentistry. You go and only for this, not root canal is a treatment, but there is a shining treatment of the teeth and all. These are all treated as a cosmetic surgery, a cosmetic treatment. So they say that it's for a beautification. It has nothing to do with some disease and therefore it should be taxable. That is what they say. Anyway, this is how it's at. So far as the Dr. Sanjeev Vasa's matter is concerned, the bench has reserved the order. It will be pronounced subsequently. Now coming to this sixth poser, this is CSR activities. So first of all, I will just give you the citations. There are 3-4 cases. 2 are in favor of SSE, 2 are against the SSE of authoritative advance ruling. Dwarikesh Sugar authoritative advance ruling Uttar Pradesh, 2021, 53 GSTL 482 is in favor of the SSE. Citation? Okay, 2021. 53 GSTL 482. And one Bambino Pasta, I think last poser of Abhay is also dealing with that. Bambino Pasta's case is almost the facts are similar over that. So Bambino Pasta is also in favor of the SSE. Then there are 2 judgments. Adama India 2023. 3 Sentex 183 authoritative advance ruling Gujarat is against the SSE. And the Polycab Wires 2019 24 GSTL authoritative advance ruling Kerala is also against the SSE. The controversy is this: Companies Act and the CSR rule says that you have to incur certain percentage of your profit before after these CSR activities. CSR rule says that this activity should not be in relation to your mainstream business. Now originally when in 2004, the definition of input service came in Senvet Credit Rules. It had a phrase called as activities relating to business is also an input service. And Bombay High Court in case of Coca-Cola 2009-15 STR 657, they dealt with this definition and held that definition they vivisected in 5 parts and say that each and every part of the definition is a separate benefit to the SSE. So that is how they vivisected and dissected the definition and then say that. So if suppose the activity, the input service is not falling into the main part, it's not relation to manufacture, not used in providing the service, but if it is activities related to business, then credit will be available. 2009 this happened, 2011 they removed that phrase from the definition, activities related to business was removed. In 2017, again when we saw this GST definition, eligibility of the input tax credit in section 16(1), it says that used or intended to be used in course or furtherance of business. So I was wondering that in 2004 you introduced, 2011 you removed that phrase, again in 2017 you inserted that. So the meaning in GST is much broader than the earlier Senvet credit regime, that is I was thinking. And to my surprise, today whatever the litigation we are looking at is half of the litigation is pertaining to input tax credit, which originally when I read the definition I thought that there will not be any litigation so far as the input tax credit is concerned. But today the situation is totally different. 50% of almost dispute is related to input tax credit. So now the contention of the department is, as per the CSR rules, whatever the expenditure you incur is not in relation to your business activities, means it is not relation to your business, and therefore you cannot avail the input tax credit at the first place because it is not eligible under section 16(1). Somehow if you say that if I don't incur this expenditure and then my other business operation will be disrupted because I violate the CSR rules, so it is in relation to my business, and that is actually held by these 2 favorable decisions also. In authoritative advance ruling, they have considered this. Another point is that under section 37 of the Income Tax Act, the CSR activities, whatever the expenditure you incur is not eligible as a business deduction. It's not allowable as a deduction. So Revenue Department can argue that since all this, if you consider in a holistic manner, then the credit would not be available. Be that as it may, because now this Finance Bill 2023 has a proposal that they say that any goods or service used for CSR activities will not be eligible as a input tax credit. Now, after this amendment becomes the operative, then this dispute will go. You will not be able to claim this input tax credit. But what would have happened in past, like you might have advised on this contrary ruling to your client that don't avail the credit. So ultimately your client might have availed the credit, then on your advice he might have reversed also. Now he will say that, see sir, now this amendment has come. So earlier I was right in claiming the credit. Now what is your answer? Now in 2009, Supreme Court in case of Martin Lottery has said that any amendment which is substantive in nature, which enhances the liability or restricts the benefit of the SSE, will be considered as a prospective in nature. So your client will say that, sir, now you let me avail the credit now for the past period. Now, what are the nature of the CSR activity? We will consider 2 types of cases. One, we can consider a case of where you purchase the cement. Actually, this Dwarikesh Sugar is also somehow dealing with that. What it says, like you purchase cement, okay, from Ultratech Cement, and you give to some trust for a construction of a school building. Now for the past, what will happen, in my personal view, credit would not be available, or you are not going to gain anything even if you are held eligible to claim input tax credit. But there are 2 ways. Straight answer is, you have availed this cement, you are distributing it free of cost. Revenue will say that 17(5)(h) of the CGST Act says that any goods given as a free gift or a disposal as a free gift, then the credit is not available. That's one. If you overcome that it's not a free gift, but it's an obligation on me under the CSR rules, therefore I can avail the credit, no problem. Then entry number 1 of the schedule 1 will hit you. It says that permanent transfer or disposal of a business asset. If you supply or give without consideration, then they say that we will consider it as a deemed supply, you pay GST on that. So you are not going to get anything out of that then. If suppose revenue succeeds on a point that you have distributed these goods free of cost, then in any case 17(5)(h) will restrict to the credit today also. for the past period also. But if you succeed in saying so, that otherwise I was eligible to claim this input tax credit, it was in relation to my business, then schedule 1, entry number 1, it will hit you. So there you will have to pay GST then. Then there was no point in taking the credit. You are not actually not getting any benefit out of it. But so far as the services are concerned, the situation will be different. Now how you can provide the services? Like you engage L&T. Instead of purchasing cement from Ultratech, now you engage L&T to construct the school building. Since L&T's activity is a works contract, it will be falling as a service. 17.5H is dealing only with goods, not services. So there you can say that even if I provide this service free of cost and I succeed on this point that it's in my business activity, I will be eligible to claim input tax credit. Schedule 1, point number 1 will not hit you on a reason that it's not a permanent transfer or disposal of a business asset. Service you consume, you don't build the asset out of that. It's a service cannot be built asset. It's a consumption of the service. So there, it's not a disposal or a transfer of a business asset. There you can argue. So far as services are concerned, you have an arguable point. But so far as the goods is concerned, for the past period, either 17.5H will hit you or this schedule 1 will hit you. Ultimately, there is no gain so far as the goods are concerned. So this is the answer for the past period. Because client will ask you for the past. He is not worried about future because in future already the government is secured that you cannot avail the credit. So that question will not come to you now. So that's the on my side.
Yes. Now this question is related to whether the service can be classified under the construction service or lease services. If you on front, just if I ask construction versus lease, everyone says that we have to see the nature of transaction and has to be decided because both are absolutely different services. But now in the present case, actually what happened, that government of Gujarat allocated a big parcel of land to particular association. That association was constituted for specific industry, for specific purposes. The government allocated this land to this association for 99 years with no termination clause, with a renewal clause also. In turn, association constructed building over it and entered into sales agreement with the members. So government entered into lease agreement for 99 years with association. Association in turn entered into sales agreement with the members. No doubt, there was 2-3 clauses were put that regarding the lease deed, and they also say that after 99 years, yes, this agreement is going to be reviewed, renewed, and there is no termination clause. One more restriction was given to member that it would be used or exclusively the object of the association. And what was the object? That it would be used only in the dealing with the diamond business. So whoever member ceases to operate diamond business and want to sell to another, it was free, but subject to condition that the another member also has to enter into, would be involved in the diamond business. He would not be allowed to sell to any member who is not in the business of the diamond. So DGGI initiated inquiry. They says that association has wrongly paid service tax under the construction, GST under the construction services for the reason that ultimately association was not empowered to sell this building because the building on which it was constructed, it was on lease basis. So if the association received this, got this land on lease basis, they cannot sell off to the members, and therefore, even though the agreement says a sale agreement, but is a misnomer word, actually it is a lease agreement only. Therefore, DGA wanted to charge by considering this entry as a fall under the 9972 and wanted to charge at a full rate at 18%, whereas associations that we have rightly paid tax under the construction at a 12%. After 21st May 2018, the lease, that lease entry, that means 9972 was amended, and they say that if there is a composite supply where include the land as well as construction, there is a 12%. So from 21st May 2018, it would not make difference for the reason that either you go on the lease, it is a 12%. If you go on the construction, it is a including land, and therefore it is also, it falls under 18%, 12%. But the question now arises, again this is a serious issue, because after BU permission, if you have classified this entry under construction services, there is no liability of GST. But if you have classified under lease, the liability continues, because it's a huge plan, huge project, and therefore there are number of units were to be sold even after BU permission. So what is the real classification of these services? That is one. Two, if we consider it is a construction services, construction services, whether credit is eligible or not. So there are 4 questions have been put. The first question, whether sale of unit by the company to its member, that means to its association, association to its member is classifiable under heading number 9954 of GST tariff heading as notified with a serial number 3 of notification 11 of 2017, or under chapter heading 9972 at serial number 16. First is a construction service and second is a lease services. If we see this entry of construction, and specifically entry number 3, IF, it says that if it doesn't fall under I1 to I, then IF is a residual category, and in residual category, it is a chargeable to tax at 18%. But if the service is supplied along with undivided portion of land, or with the portion of land, whether this land is given under the lease basis or is a freehold land, then the value of land to the extent of 1/3, which has been deemed, that has to be deducted. There is no criteria under IF regarding the sale. What is the requirement? That it should be construction services, and if you want to want deduction, that there should be the land. And the land, it has to be transferred by way of transfer of right as defined under the Transfer Property Act. And nature of transaction is not required, nature of land is not whether freehold or leasehold land. If it is so, there is a 1/3 has to be deducted. Now come to the entry of lease agreement. Lease agreement is divided in 3 parts. That entry has been divided in 3 parts. First entry is that lease law granted by the central government, state government, local authority. 2 is that this type of composite entry where the land has been transferred on lease along with the constructed unit. And 3rd is a residual entry, that means real estate services. In first and 2, first is exempted. 2 is a yes, you are eligible to get deduction of 1/3, that means a 12%, and 3rd is a 18%. So department want to classify it under 18%. Now if you see this entry, what was the reason for carry out amendment in 21st May 2018, specifically in the lease, was that they did not want to charge GST on the transfer of land. So if you see in the construction activity also, if transfer of land, they say that yes, 1/3 is a deductible. Whatever the amount total charge, 1/3 is not is to be deducted. Now in case of lease, there was no such amendment. There you have to charge GST on the entire value. To remove these difficulties, the GST Council amended this entry, no doubt through this after having proper mechanism. But because of at the request of the council, after having that meeting, they said that there was no any intention to charge on the land, transfer of land. So when any agreement entered for a long-term lease, take an example more than 30 years, then under the Transfer Property Act, it is considered as a sale itself. So they say that when you transfer the land, for example, on a long-term basis, like as a no termination clause, renewal basis, 99 year, it is considered as a sale only. Now after transfer of land, if you construct building over it, then it is a service. But which is a service is a construction services. And therefore, the government, to overcome the difficulty in the construction case, we allow them 1/3 deduction, and in case of the lease, we are not allowing the deduction. Therefore, the 21st May 2018, it was decided to deduct the value of the 1/3. Hence, now from 21st May 2018, yes, the value has to be deducted. Question arises that what is the situation in case where it has to be classified? According to me, if it is a construction, that leasehold land on which the construction has been done, then as per the definition of the composite supply, which has been defined in section 2 subsection 30, it says that what is the nature of transaction, because what is your main supply? The main supply is your construction supply, and therefore you should classify it under the construction services. 2, even though if you want to classify the 9972 after 21st May 2018, it is a definitely 12%, but yes, the issue arises after view permission, that is 2. In case, if you go on the 9972, whether would it be possible to claim credit by the members? Answer is yes, it is a credit, it is eligible for the credit because there is no embargo. And there is a one catch into it that I'll cover up in the next question. And I'm sure I have not seen this sheet, but I'm sure they say that, yeah, we should complete before 7 p.m. We'll try definitely to put our answer in a limited time.
The question number 8 relates to the late fees and the payment made by the taxpayer after passing of the DRC 7 order. The question 8A relates to the financial year 8-9, wherein Mr. Late Latif has filed all the return almost 4 months late. Somehow, luckily, the system has not showing any late fees to him while filing the return, and now superintendent has catch him that and wrote him a letter that pay the late fee. Now, Late Latif do not want to pay the late fee. What will be the legal recourse for him? Can the superintendent demand that late fee under section 73-74 or not? As Jigar Shah said, section 73-74 only have a provision to make the payment short paid, not paid, wrongly avail ITC and corresponding interest and penalty. Late fee is not specifically prescribed under section 73 and 74. So there will be no recourse for the superintendent to demand the late fee by exercising power under section 73 and 74 according to me. And the other question is relates to the demand raised by the DRC 7 order, wherein 1 lakh is the tax amount, 54,000 is interest amount, and 1 lakh is the penalty amount by passing the demand DRC order. Now, Mr. Late Latif has paid that 1 lakh after 1 year. So far as GST Act, this question has been posed in a context of the VAT Act. See, under the VAT Act section 30 subsection 5, it speaks that wherever any demand has been cropped up due to VAT assessment order and the demand has been paid by the assessee, then that demand will, the payment of that amount will be first credited towards penalty, then interest, and lastly it will be the adjusted toward the principal amount. Whether that similar provision are having under the GST Act or not. So GST Act does not have a provision like that. So wherever any demand has been cropped up and taxpayer is making payment of the principal amount, from that day interest will not be calculated by the system. Thank you very much.
Question number 9, basically issue relates to the late issuance of invoice. The facts are that this is a company where, considering the nature of service, it requires the approval by the customer. In this situation, the customer made a delay because of some technical issues at their end, and approval came after the period of 30 days from the end of from the date from which he had actually completed the service. Now the auditor is of the view that because the invoice has been issued late, so interest should also be paid on the late deposit of GST. If you see the law quickly, section 31(2) contains the provisions related to invoicing in case of services. If you see that provision along with rule 47, it would entail that in case of services, the invoice is required to be issued within a period of 30 days from the supply of the services. When there is a continuous supply of service under 31(5) based on milestone or payment, you can issue the invoices. Now in this situation, when can we say that the supply of service is over? Now, in pre-GST era, in the context of service tax, we had two board circulars. One was circular number 166 in the context of insurance industry, where the board has clarified that by merely sending reminders for paying the insurance premium would not imply that the services has been rendered. That is just a reminder. It is only when the contract is entered into, when at that point in time it would be considered that the service has been rendered. So that would be the point at which the requirement of issuing the invoice and payment of service tax would happen. Another important circular, circular number 144, that says, and very rightly, that for issuance of invoice you need value. Now that confirmation of the value depends on the approval of the timesheet by the customer. In absence of the approval of the timesheet, the value of supply cannot be determined, and therefore, unless that activity is not undertaken, it would not imply that the provision of services is over. The provision of services continues till the time the customer ultimately intimates the acceptance of the value of services, and it is at that point in time that the requirement of issuing invoice within 30 days from that date would happen. So I would say that law in GST borrows similar principles of the erstwhile law. So same propositions should apply. So in this situation, unless the timesheets are not approved, and the contract will certainly have that clause. In fact, if you see even government contracts, so this issue happens ordinarily in government contracts, there is always a clause which says that only after the approval, the invoices can be issued. And only at that point in time, the GST liability is normally paid by the government contractors. To my mind, that is the right proposition, because the contract, when clearly stipulates as an event that only after that event that the right to issue of invoice would arise. So certainly a law cannot prepone that event by saying that just because physically the performance of service has happened and therefore the invoicing should have been done. There is also a set of decisions. One can refer to this latest decision in the case of Saloplast, Bombay High Court, where the courts are saying that law cannot impose something which cannot be fulfilled by the taxpayer. So here, when the contract itself clearly stipulates that only after the approval the invoicing is to be done, so certainly this proposition would also apply, and therefore on both the grounds, one can say that in this situation the service is not yet complete. It is only when the timesheet is approved that the service can be said to have been actually supplied. And within 30 days of that date, there will be an obligation to discharge the tax. So to my mind, there should not be any interest liability in such situation.
The next poser is a classic case where a GST officer sitting in an air-conditioned chamber can bypass the parliament. Of late in service tax, they realize that there should be a time limit for adjudication. So they inserted a specific section, 73(4)(b), which says that as far as possible, you finish the adjudication in 1 year. And Delhi High Court also set aside one demand where the commissioner passed the order after 1 year. He said that he has not recorded any reason why he took so much time, Sundar systems. So this order cannot sustain. So High Court has held so. In our GST law, there is an inbuilt mechanism. As I said, there are only two sections for recovery, section 73 and 74. 73 without suppression, 74 with suppression. Now, so far as the demand pertaining to 2017-18 is concerned, as per section 73(10), the order has to be passed within 3 years from the last date of filing the annual return. Now for 17-18, the last date of filing of annual return was extended up to 31st January 2020. Okay. Now last date for passing the order for 2017-18 without suppression was 31st January 2023. And section 73(2) says that before you pass the order, issue show cause notice at least 3 months prior to date of issuance of the order so that SSC can reply. So the last date for issuing the show cause notice without suppression was 31st October 2022. If the GST officer issues the notice on a 1st of April 2022, 1st of November 2022, notice is time barred. He cannot proceed with the notice. That the law says. Now what happened, because the GST officer thought that I need to give time to myself for passing the order, therefore power given to me under this GST law for my own benefit I am issuing the notification to grant myself more some time to pass the order. Therefore, he issues a notification. On the 5th of July 2022, the notification has been issued granting more time to the GST officer for passing the order, extended by 8 months. So now, 30th September 2023 is the last date for issuance of the order, not the show cause notice. Show cause notice, 30th June 2023. If GST officer issues a notice on a 1st of July 2023 for 1718 without suppression, it is time barred. This is the law. Now, you will be wondering that why this GST officer granted himself a time of only 8 months. He could have done it for 10 years. Why only 8 months? If he has to bypass the parliament, parliament's intention is very clear, that you pass the order within 3 years. There should not be any uncertainty on the mind of a SSE. So if you want to give time to yourself, why you are giving only 8 months? You should have done it for 10 years. So if even this for all 10 years long period, if you don't pass the order, it's okay. Now the another consequence is, if you look at the provisions of section 75.2 and 75.3, today, because they are running short of time, so they will allege suppression on your part. Like a present case, there is a issue of denial of input tax credit of repair and maintenance of motor vehicles, which subsequently they say that we will not give you the credit now. See, in those days if I availed, because you amended the law subsequently, in those days I availed the credit. What is wrong in that? Even if they now allege suppression on your part, and subsequently by the, let's say, the Additional Commissioner Appeals or GST Tribunal holds that there was no suppression on the part of the SSE, then they say that all the provisions of section 73 will apply. So today, they are under the overconfidence that I will allege suppression on the part of the SSE and I will succeed also. But tomorrow, suppose the GST Tribunal says that there was no suppression on the part of the SSE, then he will have to go to 73. So what will happen? For 1718, the GST officer, under the overconfidence, he will say that I will issue the notice after 1st of July 2023. And tomorrow, the GST Tribunal says that there was no suppression on the part of the SSE. Then whole proceedings will go. You will be wondering, this is a provision, and they have explained this provision by way of a circular. There is a 27th December 2022 circular, which says that suppose tomorrow the allegation of suppression is not sustained, then the time limit of section 73 will apply. And since he has not maintained the time limit, whole proceedings will go. So the only endeavor on your part for tomorrow is that ultimately you, if on any issue, if it is held that there was no suppression, you are through. You need not have any other argument. In fact, after this notification, in Kerala High Court, one SSE, Pappachan Chakkiyat, its citation is 2023 to Sentex 322, Kerala High Court. That challenged the section 73 notification. He did not challenge the notification. He says that since the 7310, the notification says the time limit for passing the order under 7310 is extended to 30th September, but there is no corresponding amendment in 73.2. He did not challenge the validity of the notification. Okay, so you have a point to argue of validity of that notification. How an officer can, sitting in an air-conditioned chamber, can bypass the parliament? That notification cannot work. You will have to challenge that validity of the notification. He cannot grant time to himself that I forgot to pass the order. I didn't have time, therefore I am extending time for myself. How this can be done? So proper way is to, even today if the notice is issued or the order is passed, according to me, this notification should be challenged before the High Court, and if its validity is struck down, then all the proceedings for 1718 at least will go. Citation, Kerala High Court, Pappachan Chakkiyat, 2023 to Sentex 322. The SSE only said that there is a notification refers to only 7310. So time limit for issuance of the show cause notice is till 30th September 2022. 31st October, sorry, 2022. But the court has said that both the sections are linked with each other, and therefore even the 7310 time limit is extended, so automatically 73 time limit is also gets extended. But SSE did not challenge the validity of the notification, so that point is still open. So this, in time to come, this will be a very interesting litigation. Service tax you will have to refer to the Finance Act 1994. It is not dealt with by GST law. Maximum 5 years. And that is what the Usha Martin's case, Jharkhand High Court says, that 174 is for initiating the investigation under the earlier law. You cannot catch the bus of 174 to initiate the investigation under GST. That time limit has gone, then SS is free.
Same High Court judgment can apply for the purpose of wrong trade transfer credit leaving.
Sir, whatever seems favorable to you, you can apply anywhere. Here and there, somebody will hold it.
No, this notification, I only have one point. If you see 168 capital A, which was inserted by Tola, that gives express power that in a force majeure situation, they can issue a notification and extend the timeline. They have defined force majeure. So,
Yeah, but that is the reason the law was amended. They issued the circular where they want to extend the time limit.
That is, you have a lot of time even after this second wave of COVID 2020 when it got over, June 21. Thereafter a lot of time was there. You could have very well, if there is no suppression on the part of the SSE, everything was available with you, no?
this power is available
so-
in law.
Subject they have to apply it. They have to say that.
Right.
And that
In this notification, they are saying that 168 capital A.
168 they say that, but wherever they wanted to extend the time limit, take an example of refund, take for issuance of the SOCOS notice, they say that this time limit from so and so up to so and so time is to be excluded. Now that power has, how they have power, access to the power, because of this provision only. That is a reason. They can do that. So my next question is again is a very general questions, that nowadays DGGI or any GST authority, they search the premises. Three things happen. One, they seize documents. Two, seize the goods. And many times they seize the cash also. So it is in respect of the seizure. And arrest is a person. So we are not dealing with the arrest now, just we are dealing with the seizure. First question arises whether DGGI has a power to seize either goods, books or things, now including cash also. So this was challenged before the different high courts. Even our Gujarat High Court, in the case of Yasho Industries Private Limited, they said that yes, DGGI has a power because this petition was challenged on the premise that under the Customs Act, if DRI has issued the SOCOS notice, that means Director of Revenue Intelligence, or whether they have done seizure, whether it is permissible under law, then Supreme Court in the case of Canon India Private Limited, they says no, DRI has no power. To get the same benefit, one of the assessee in Gujarat also challenged before Gujarat High Court that whether DGGI has power for seizure or not. That gave negative decision. They say yes, DGGI has a power to seize has a power for seizure as well as the issuance of the SOCOS notice. Question arises whether cash can be seized or not. Because if you read the section 67 and specifically subsection 2, the power for seizure is given to goods, documents, books or things. And if you read the definition of goods under 252, it says that goods means all type of movable properties, movable goods or movable assets, excluding shares and securities. If you see the definition of service, then it says include goods, but again exclude money and securities as well as services. So a question arises whether cash can be seized or not, whether the things include cash or not. So Delhi High Court recently in the case of Arvind Goel, they said that the Delhi High Court said the cash cannot be seized. And what is the reason for that? They applied two principles. One is the adjacent generis principle, that when the word you read things in terms of doctrine of adjacent generis, that first is a goods, documents or books, but the cash does not carry the same nature of the transaction, the same nature of the things, and therefore cash is excluded. One. Two, Delhi High Court also said that there is required proper seizure memo, which is prescribed under that. Under Panchnama, cash cannot be seized. And I'm sure that you have come across situation that many times the DGGI or any authority, they found unaccounted cash, they seize this cash. So Delhi High Court said, no, it can't be done, and absolutely, even though we read the provision, it clearly mentions that, yes, cash does not cover other things. So that is one. Two, now in respect of the goods, if power is given for seizure of goods, answer is yes, because it specifies that. But once the power is given, does not mean that for perpetual period till the issuance of notice and adjudication of the case, they can keep the goods with them. Answer is no, they can't keep the goods with them. Section 67, subsection 6, if you see, power has been given for release of the goods. Subject to, you have to, the assessee has to make an application for release of the goods. Now when the order is given for release of the, normally the order is given for release of goods only subject to, you provide security, because earlier under a regime, like under excise or under the Customs Act, they says that the discretion was given upon the adjudication authority to decide volume of security. But under the GST, no any discretion has been given. They say that once the goods has been seized, then in terms of Rule 140, the security has to be given to the extent of value of tax, interest and penalty involved in the matter. Now what is the security? Normally the department demands bank guarantee or equivalent that encashment of the security. So they demand that. Now in that also there is a catch. If you apply and they grant provisional release, a period fine. But if they don't pass an order for provisional release of the goods, then time limit is given that yes, within 6 months they have to decide whether they want to continue with the seizure or not. If they want to extend this seizure with the approval of the higher officer, that means commissioner, the seizure can be extended till further 6 months. So first 6 months, if they want to extend this time limit, yes, they can do for further 6 months, subject to condition that the approval from the commissioner is required. But if no order is passed or no action has been taken within a period of 1 year from the date of seizure of goods, then it is required to be released immediately without even providing the securities. But does not mean that the SOCOS is also required to be issued 1 year. SOCOS section 73 and 74 as discussed, it prevails. So time limit for issuance of the notice, it would be as per section 73 and 74, but for the purpose of goods, it has to be released not within the period of 1 year, but not beyond the period of 1 year. Now last thing is the documents. So first we have seen the cash, second we have seen the goods, and now we are seeing about the document, what is the procedure for that. There are two types of documents. One, which has been relied by the agency, investigating agency, at the time of issuance of the notice. And two is the non-reliance upon the documents, RUD and non-RUD. So in respect of RUD, if the assessee demands, it is an obligation upon the officer to provide these RUDs, photocopies of the RUDs. If they want to decline to give you the copies, they have to give reasons. That if I give you the documents, if I furnish these documents to you, then it would be prejudice to the interest of revenue, or there will be loss to some revenue to some extent. They have to pass an appropriate order. No doubt that is a challengeable order, but yes, order has to be passed. In case of the non-reliance upon the documents, it has to be immediately released on demand. So these are the provision for goods, cash and the documents.
Question number 12 is in a context where the supplier has raised two invoices. First, what will happen? ABC is a recipient of goods wherein the supplier has issued invoice number 1. He also generated e-way bill. Later on, there is a sort of a quantity, so he sent the second quantity by way of a delivery challan. And he has not generated the tax invoice for the same, and he invoiced 2. He has also not generated the e-way bill, but the goods has been ultimately sent it to you. Thereafter, supplier has, what he has done is, he has used the IRN number of invoice number 1 in invoice number 2. he has not separately generated any second IRN for invoice number 2. And he has also give a credit note and uploaded that credit note on the portal and knock up the invoice number 1. In nutshell, what he has done is he has sent 2 quantity, he has sent the second bill, wherein he has used the IRN number 1, IRN of invoice number 1 and claim a money of the GST from the ABC. Now in that scenario, whether ABC is entitled to claim an ITC on invoice number 1 or invoice number 2, because what will the portal is showing is invoice number 1, against which there is a invoice number 2, but that invoice number 2 is containing the IRN number of invoice number 1, which had been already knocked up by the credit note. So which will be the correct invoice on which ABC can claim an input tax credit? Generally, this is the question pertaining to the FY 21-22, and what he has to do is, he has to amend the credit note and invoice number 2. But time has been left. After November, he can't do the amendment in the invoices what he has uploaded on the portal. And therefore, ABC is now not willing to make payment of the GST amount pertaining to the second asset sold, supply by the supplier. So, in my view, ABC has to accounting only invoice number 1 in his books of account. He has already released the basic principal amount of the invoice number 2. So both the asset, ABC has made the payment of both the asset principal amount to the supplier. He has also paid GST of invoice number 1. But so far as second asset GST is concerned, he has not released the payment to the supplier. Because he has not account for the credit note, so he has correctly accounted invoice number 1 and he is entitled to get an ITC on the invoice number 1. This type of question you will found at the time of making audit of the QR code scanning. When you are going in the audit, GST audit, you just make the scanning of the QR code affix on the invoices. Generally, we see all the invoices with the QR code, we understand that this invoice is correct. But many times you will found that invoice has been tampered by the another IRN. So you have to take care while you are dealing with such type of cases. Thank you. Yes. See, so far as invoice number 1 is concerned, tax invoice is there, 180 days payment is there, receipt of goods is there, e-way bill is there. So every condition has been fulfilled.
See, question number 13, again, it's a very common issue that we all of us must be facing. As you are aware, under GST law, if you are importing any services, then tax is required to be paid under the reverse charge mechanism. There is section 5(3) of the IGST Act, read with notification, which imposes this liability. Many times it happens that payments of 17, 18, 18, 19 are recognized today, and therefore the tax is now paid. The question is, can we avail the input tax credit? Because these are all the payments in respect of expenditure which is otherwise eligible for the tax credit. So the question revolves around 16(4) applicability in such situations. So in case of a reverse charge, under section 13, subsection 3, a recipient is obliged to make the payment of tax either at the time of making the payment to the foreign party or 61st day from the issuance of invoice, whichever happens first. That is the time of supply at which your liability to pay tax under reverse charge would happen, which in our case is of April 18. Payment is done now. So there is a default, and obviously there will be some interest liability that he may have to pay. Can that be the basis to deny credit by applying 16 subsection 4? If you see the language of 16 subsection 4, it is basically restricting the claiming of the credit in respect of invoices issued for supply of goods or services beyond the month of November of the next financial year to which the particular invoice pertains. So the restriction is linked with the document date of the invoice. Now in this situation, there is a requirement to generate a self-invoice because the foreign party is an unregistered supplier. Now that requirement and that document becomes the base document under Rule 36(1) to avail the credit. If you see Rule 36(1) in this context, it says this self-invoice would be the base document subject to payment of tax. So there is a condition attached to that base document to say that the document would not be sufficient to avail the credit. It should ultimately be subject to the payment of tax. Credit can be availed in the month in which document is issued, but this would still be subject to final payment of the tax. So to my mind, if the invoice, self-invoice is issued today and the payment is also done today, it would be a credit of this financial year, and therefore applying 16(4), the restriction applies only if I avail the credit beyond November of the next year. Since I am making the payment today, issuing the invoice today, I would be entitled for credit. Bar of 16(4) should not apply. There is also another proposition to consider here. 16(4), the language uses, it applies to an invoice issued for supply of goods or services. If you see in this situation, when you see section 31(3)(f), it says what is the obligation on the recipient is to issue an invoice for the receipt of the goods or services attracting tax under reverse charge. Even 16(4) proviso, which extended the timelines for the first financial year, 17-18, also puts a condition that unless that invoice is furnished in GSTR 1, only in that situation that extended window from October 18 to March 19 is available to avail the credit. So this is again talking about invoices issued by the supplier of goods or services. So a view can be taken that 16(4) applies only to the invoices issued by the supplier. It does not apply to the invoices which are issued by the recipient, indicating the receipt of goods or services. So on two grounds, I think credit can be availed. 16(4) bar should not apply. First, the base document is of current year. So in any case, the restriction of 16(4) is linked with the document date. And since document is of current date, the restriction would not apply. And even otherwise, 16(4) in general can be argued to not apply in a situation where the liability is under reverse charge. So on both the grounds, the credit should be eligible.
The next one is of taxability of the vouchers. So in many companies, what do they do? They, like Amazon, you want to gift someone, so you will purchase the gift voucher on Amazon and you give it to your friend. Now he can encash it against the supply of services, goods, whatever he may like on Amazon. So the issue arose in case of Kalyan Jewellers. They say that we also issue the vouchers to the customers. Customer can go to any store of Kalyan Jewellers and encash that. So the authoritative advance, the contention of the SSC was that it is nothing but an actionable claim and therefore GST is not payable because it's falling into, actionable claims are falling into Schedule 3. AR Tamil Nadu said that no, you have to pay tax, and because it's a goods only, time of supply would be when the voucher is redeemed. SSC filed an appeal before the appellate authority. Appellate authority says that on a one point we agree with this, that is taxable because it will be treated as a goods, but to the extent they say that the time of supply is a redemption, that we don't agree. Time of supply at the time of issuance of the voucher itself. So whatever the relief SSC got, that was also snatched away from him in the appellate authority. Luckily recently, the Karnataka High Court has dealt with this issue, and if you look at this, both these Kalyan Jewellers judgments are also referred into that. So you need not write down the citation of Kalyan Jewellers. Only this Premier Sales Promotion 2023, 3 Sentex 64 Karnataka High Court. There they have held that vouchers are nothing but the payment instrument. If you look at the RBI guidelines on this payment instrument, prepaid payment instrument guidelines are there. They say that vouchers are nothing but equivalent to cash. So in Karnataka High Court has said that this is nothing but a cash, and therefore the money, it's a money value only, therefore it is outside the definition of goods and services, and therefore it is not taxable. So it's a relief giving judgment on these vouchers, taxability of vouchers. Then they say that therefore it is outside the purview of GST. That is what is held in this. So vouchers are not taxable. In fact, Karnataka High Court relied on another judgment of Supreme Court, Sodexo. The main issue was Sodexo vouchers were given to the employees by the company. In Maharashtra, they wanted to levy local body tax on that. Then it was held that it is nothing but it's not a goods. Therefore, local body tax cannot be levied on this. It's a voucher. It's a money value. So same principle has been followed in this Karnataka High Court, and they have said that it's a money value, no tax is payable. So today you purchase 1,000 rupees gift card for your friend and you give it to him, no tax is payable because it's as good as money. But when he encashes that voucher for, let's say for example, he purchases some goods on which the 18% GST is applicable, so it will be considered as a come tax value of 1,000 rupees will be redeemed. In that way it will be. And at the time of redemption only that it will be taxable. So that is how it has been held.
Now this question is related to eligibility of input tax credit. If you see the section 17(5), subclause H, it says that ITC is not eligible for goods lost, stolen, destroyed, written off or disposed of by way of gift or free samples. Now the question, the consideration is that the assessee purchased the scrap, MS scrap. It has been used in manufacture of iron ingots. During this process, some of the because in scrap there was some impurities and therefore there was a loss, and the yield was not 100%, but yield was around 95-96%, or it depends on the impurities involved in the scrap. The department alleges that yes, you are not eligible for the credit to the extent of the loss incurred in your input, because when you purchase the input, you avail 100% ITC, but yield is not 100%, and therefore to the extent of loss of your input, you are not eligible for ITC by relying upon section 17(5)(h). So the question on the consideration whether the word used in the loss, goods lost, has to be read in a verbatim form, or whether the legislature has intention to deny the credit irrespective of the seeing the transaction, that whether this loss is incurred in a normal course or even abnormal situation also, this loss, the ITC to the extent of loss has to be reversed. So this similar situation arose in the case of ARS Steel and Alloys. The Madras High Court says that the word the goods loss which is used in the 17(5)(h), it has to be read not in the context where it has been used in manufacture of your final product, because it is a normal loss. It is an inherent loss, because when you purchase any scrap, there you find some impurities, and that impurities is going to be removed while manufacturing of your final product. Hence, this says that the word lost which has been used under the 17(5)(h), it has to be read in the context without even procuring, even without getting into this factory or your place of business, if it has been lost. Does not, again, like take an example of some liquid product. When you bring it into a factory or into your place of business, there is some evaporation. Then also you are eligible for the credit. So here this lost, that means in the terms of like theft or similar type of situation, those situation you are not eligible for the credit. But in other circumstances, when there is a normal loss of while manufacturing or even while transportation, those is to be permitted.
Question number 16 is in relates to the generation of an e-invoice and provision of the time of supply is concerned. One XYZ registration number has been cancelled in July 22, and he has also filed an appeal for the same. After 6 months, his appeal has been, his registration number has been restored, but somehow he has done the business during that 6 months, and therefore he needs to generate the invoice for the supply of service made by him. Now, if he generated his invoice, e-invoices after 6 months, then the IRN is showing the date of generation of the respective month, not of the previous month, though he has provided service in July 22, August 22, November, September, whatever month is there. So he has a very peculiar question. If he is generating the invoice in January, February, then from where he needs to pay the tax? From the date of generation of an invoice or from the date of provision of supply of service? The time of supply provision says that whatever event occurred at respective time from that day, he needs to pay tax, and if he has not paid the tax, then there will be the liability to pay interest is also there, because he has collected the tax from the customer and not deposited into the government treasury. He cannot take a shelter that my number has been cancelled and therefore I need not require to pay interest on the deferred payment made by him. So this is the answer. Looking to the you need to check the time of supply provision, which says that whichever is the earliest event, on that day he needs to pay tax. Thank you.
See, question number 17 deals with an educational institution. So as you are aware, all these educational institutions, apart from charging tuition fees, they charge separately for uniform, books, stationery, etc. So her first question arises is whether those supplies would be considered as an independent supply and therefore liable to tax, or will it be considered as part of a composite supply of educational services and therefore will be exempt from tax. If you see entry 66 of notification 12/2017, it says services by an educational institution to student, faculty and staff is exempt. Goods is not exempt. So if it is an independent supply, then certainly this exemption would not apply. Now whether is it independent or is it composite, one has to look at the definition of composite supply. It says two or more supplies which are supplied in conjunction with each other and which are naturally bundled. One can very well say that there is no criteria that there should be a single price for a two or more supplies to qualify as a composite supply. There may be an independent value assigned to uniform or books or stationery item, but that would not imply that this would not be a composite supply. If it is naturally bundled and supplied in conjunction with each other, it would continue to be a composite supply. To my mind, in this sector, certainly when a student enrolls with educational institution, along with education, these are all going naturally bundled, because for a student to study, he will certainly need access to all these goods. We have also a recent decision in the context of income tax, which would apply also in the context of GST in the case of New Noble Education Society, where the Supreme Court has said that such incomes in the nature of textbook or transport fees for children or some special summer camps are there, and for that some extra money or some special coaching is undertaken outside the normal school hours for the existing school children. Hostel facilities, they are all incidental to the main activity of education. So that basically brings in that naturally bundled element, the test which is there in the context of GST, and therefore to my mind this proposition can apply and therefore this would not be liable to tax. Second issue is that it has an auditorium which is rented out to third parties for conducting seminars and music programs. This to my mind would not be exempt. This is not a services to student, faculty and staff, and therefore this would be liable to tax. Third, last question is they also conduct some extra coaching for certain entrance examination like NEET, IIT to their own students, and separate fee is collected. Whether this would be liable to tax, because please understand this coaching does not result into issuance of any degree or diploma or a certificate by the board. So it is in that context this poser has been put, that whether such coaching of entrance examination by a school, whether that would be exempt from tax. If you carefully see the exemption entry 66, it says that once an institution qualifies as an educational institution, then all services to the student are exempt. It does not then restrict itself to only services qua the degree or diploma recognized by any board or authority. The definition of educational institution only covers those institutions who impart such education. Once you qualify as an educational institution, then any services to your students would then qualify for exemption, irrespective of whether that service results into any degree or diploma. So to my mind, in such situation, as long as this income is from their own students by an educational institution, it would not be liable to tax. But of course, if there is a private coaching center who is also undertaking such activity, then that would be liable to tax.
The next exposure is also very common, and many of you may be facing this mismatch of a credit between GSTR 3B and 2A. So they have this 2A provisions from 9th of October 2019. So for the 17, 18, 18, 19, it was not there. And there will be some bona fide mistake, like the GST number is not put correctly. The supplier has classified his supply as a B2C, while it's a B2B. So it will not get reflected in 2A, but you will be eligible to claim credit. So there were some bona fide transactions or bona fide mistakes where you are deprived of your right of availing the credit because of this mismatch. So they issued one circular, bona fide circular, beneficial circular in fact. It says that wherever this type of discrepancies are there, if the input tax credit is in excess of 5 lakhs, you get it certified from the chartered accountant or a cost accountant that the assessee is fulfilling this condition. He has received the goods, he has received the invoice, he has made the payment to the supplier, only that condition. So it's otherwise an answer to this all this query of section 16(2)(c), that when the section says that I have paid the tax to the government, circular itself says that you verify that only, that whether the recipient has made the payment to the supplier, that it's a fulfillment of condition of section 16(2)(c). That circular says. But circular says that since from 9th of October 2019 we have this provision for GSTR 2A and SSE was entitled to credit according to that, therefore we will give the benefit of this kind of mistake, correction of this mistake only for 17, 18, 18, 19. We will not extend it to beyond. So in a very good judgment of Karnataka High Court, in a case of this Wipro Limited, 2023 TIOL 84 HC Karnataka GST. It has been held that this benefit of this circular is to be given for the subsequent period also. It cannot be restricted to this 17, 18, 18, 19. Because all these mistakes are bona fide mistake, there is no point in restricting this. If this matter can be resolved otherwise, then it has to be given. So in this type of bona fide mistake, if there is a mismatch, and you can prove that these were all bona fide and covered by the circular, so that benefit can be extended even beyond that. So far as this mismatch is concerned, you can also refer to this judgment of Bharti Airtel 2021 54 GSTL 257 Supreme Court. In fact, this the decision was against the SSE, but the observation made by the Supreme Court where says that there is no difference in claiming the SENVAT credit and input tax credit under GST. It's basically on your own assessment. If you have the documents available with you, that was the condition under Rule 9 of the SENVAT credit rule also, the same condition is there in section 16. So there is nothing new. So in any case, otherwise you could have claimed the credit. So if you are facing the show cause notice and all, where because this circular will not, circular you can obviously take the benefit, but it will require the verification. If the assessing officer does so, you get the relief, good. But if this pending before the appellate authority will say that all this verification, original verification I will not do. And if you have to file an appeal before the GST tribunal, it's a more difficult case because the tribunal will say that we cannot reduce ourselves to assessing officer. You go back and explain him that these are the circumstances and you get this. In those cases, you can rely on Bharti Airtel. Bharti Airtel substantively says that the SSE was otherwise eligible to claim input tax credit. He has all the documents. Then there is no point in denying the credit. So this concept of mismatch between GSTR 3B and 2A can be answered by way of this observation made by the Supreme Court. That can be beneficial. The 2B will be a different situation, sir, because this now the section amended, and they say that whatever he is filing the return under 37, what is getting reflected, that only will be there. So this additional condition put in this. Well, from prior to 1st of January 2022, this condition was not there. So in GSTR 3B 2A mismatch will be for that period only. But that you can argue on this way.
This next exposure is related to credit note and as well as whether the refund which has been received that is required to be returned or not. On these two aspects, this next exposure is that. This question is that one company, they exported the product. This payment from the foreign recipient is received subject to quality check of the product. If the recipient finds that yes, it is absolutely as per the order, then 100% payment is made. In case, if it is found that there is deteriorate quality of the material, or there are some problem in the quality of material, then they deduct some amount and the balance amount is the return. Now in that situation, the first question arises that to the extent of shortfall of payment, whether company can raise commercial credit or not. Because if you know that the credit note, normally credit note remain credit note only. The intent of credit note is to that to that extent, recipient is not required to make the payment. But the first time concept came in under GST, there is a commercial credit note also. Otherwise, if you see the credit note under section 34, there is no any prefix. It is credit note only. But law later on by the circular, by way of specific circular, this is that now there is a concept of commercial credit note. And why they have to come with that commercial credit note? Because section 15 says that credit note can be issued only in the case where at the time of supply or before the supply, it has been decided between the buyer and the seller that yes, this is the credit is permissible or this is the discount is permissible to the buyer. If it has not been decided at the time before the time of supply, but at least at the time of issuance of the invoice, if it is an understanding between the supplier and the recipient, then yes, credit note can be issued. As per section 34, under two circumstances, credit note can be issued. First circumstances, when there is a deficient in the supply, that is the first circumstances, or second, when there is a return of the goods. So in those two circumstances, credit note can be issued. Now if those conditions have not been matched, take an example, section 15 is violated, or there is no fulfillment of the condition as prescribed under section 34, then the board has come with the criteria that yes, you can raise the credit note, commercial credit note. So, and that concept has come through circular number 92 that was issued in March 2019, that yes, commercial credit note can be issued. Now question arises whether if the commercial credit note is issued, is it an obligation upon the supplier to reduce the tax liability? Answer is no, there is no compulsion, because commercial credit note can be issued without any reduction in the tax liability. Now there was no clarity that whether, since the payment is not received by the supplier and the recipient did not make the payment, whether that credit, 100% credit is admissible to the recipient or not. Since this issue also arose, and therefore board has again amended the earlier circular through circular number 105 and said that normally as per the section 16 of CGST, credit is permissible subject to 100% payment is made. If the 100% payment is not made within the 180 days, then ITC to that extent is required to be reversed. Now here, to the extent of commercial credit note is issued to the recipient has not made the payment to the supplier. So question arose whether recipient is eligible for 100% credit or not. So the board has clarified by way of circular number 105 by saying that yes, the restriction which has been provided under section 16, it is not applicable. Credit is 100% admissible to the recipient. There is no problem on it. So this is the two circular, their clarification has been given. But now what is the situation when the goods were exported by utilizing this 100% credit? Because as per provision of the IGST Act, it is considered as a zero-rated supply. The supply used this credit and supplied with payment of full IGST. So there is a problem in the quality of the material and the credit note has been issued. So question whether the payment, the cash which has been, the question is that to the extent of what the payment is not received, whether the supplier has to return this refund or not. Because one of the condition, if you see the one of the condition under Rule 96B is that the payment has to be received by the supplier. And this law, Rule 96B, came into force from I think 2019 only. Before that, there was no such condition for the goods. In goods, once you export the goods, you are eligible for the 100% refund. But the criteria regarding receipt of the foreign currency within the time limit as provided by the RBI or within that extended time limit, the payment has to be received. So here, in case of the quality issue, the payment has not been received. Hence, the supplier has to return this refund to the extent of the payment is not received. That is one. Two, this while returning the amount, the supplier has to pay an interest also. And therefore, now before 2019, before this amendment came into force, the criteria regarding non-receipt of payment, now that has been gone away, and therefore, supplier has to return this refund amount.
I would just like to interrupt, sir. We are falling a little short of time, so I request all the dignitaries on the dais to take up their last questions and sum it up in brief. And the remaining questions, the answers to those will be circulated online at the earliest. Thank you so much.
Question number 20 is in relation to the online selling of the coupon vouchers. The taxpayer is selling online coupons and voucher to the restaurant industry, customer of the restaurant industry, and he is posing whether am I a e-commerce operator or not. If you refer the definition, section 245, it speaks about the e-commerce operator, and looking to that definition, the person who is selling voucher coupons on the online platform, he become an e-commerce operator. There is no doubt at all. He become an e-commerce operator. The second question is he need to pay tax under reverse charge mechanism or not? Wherever he is selling a voucher for the restaurant industry on online basis, so is he need to pay like a Zomato Swiggy when you are receiving the food from the Zomato Swiggy? The Zomato Swiggy is charging tax to you under 9.5. So similarly, this taxpayer needs to charge tax under 9.5 or liable to pay tax under 9.5 or not. The question is, he is not delivering the foods like the Zomato and Swiggy. So in that scenario, wherever he is selling voucher, he is not required to pay any tax under 9.5. Looking to the FAQ issued by the CBIC, TRU unit, I think tax research unit 167, dated 17th of December 2021. So looking to that, he is not required to pay tax under 9.5. Then the third poser is he need to deduct TCS because he become an e-commerce operator. An e-commerce operator is compelled to deduct TCS under the GST Act. Wherever he is making a payment to the unregistered customer, then he needs to deduct TCS or not. The answer is GSTR 8 is required to be filed for the same. Wherever any registered taxable person deduct TCS, then he needs to file GSTR 8, and the return must have a column that he needs to punch the GST number of the respective taxpayer for whom he has deducted that TCS. So far as provision is concerned, provision is also itself clear. Okay, wherever any person is deducting TCS, the person whose TCS has been collected must be the registered person. In nutshell, TCS is not required to be deducted by the e-commerce operator in a case of an unregistered person. Then the last poser is from which state he needs to pay if he is incurring the commission from the other state. So is he need to take registration in that state, or from Gujarat can he raise an invoice of a commission to the respective customer of the outside state of Gujarat? As Abhay Bhai has explained, the location of a supplier of a service, similar rule will apply, and there is a T&D advance ruling decision is also there, which speaks that wherever if the supplier of service is situated in Gujarat or any state and he is provided service from that state, then in other state it does not require registration. Thank you.
So question 21 basically is a issue where the hotel claims that the tariff that they have published, which is a declared tariff, is 5,500, whereas where they have permitted the aggregator companies like Agoda, Expedia to basically obtain room bookings on their behalf, there the tariff declared is above 7,500. So the question is whether the restaurant situated in that hotel would attract GST at 18% or 5%. As you would be aware, GST of 5% applies to restaurant services if that supply is from a place which is not a specified place. The law defines specified place to be a premises where the declared tariff is above 7,500. So issue is which declared tariff to consider. If you see the notification, the definition of declared tariff expressly covers only the tariff which is published by that unit. However, the board came out with a circular 27, where they said that if the tariff is declared at multiple places, like websites in our situation, then which tariff to be considered? The board says the highest tariff. So if my published rate card is 5,500, but if the Agoda advertises my room at, let us say, 8,000 and then maybe offer some discount of 3,000, the board says the tariff of 8,000 will have to be considered, and since it is above 7,500, the restaurant supply happening from my hotel would attract GST of 18% and not of 5%. To my mind, the board circular is incorrect. The definition of declared tariff expressly says it is only the tariff which is published by the unit, in our case the hotel concerned. There is a subtle principle that through a circular you cannot add a condition. One can rely on the decision in the case of Intercontinental India 226 ELT 16, where the Supreme Court says that if a certain condition is imposed in a notification, a circular cannot add additional condition to that notification. Here the CBIC circular is adding an additional condition by saying that if the tariff is declared by other agencies, and ultimately the highest of that tariff is required to be then applied for considering the rate for restaurant service. That is an additional condition. That is totally redrafting of the definition of declared tariff as it exists in law. That cannot be done by virtue of circular. In any case, one more argument also can be taken, that all these tariffs which are declared by all these websites are for obtaining their bookings. As a unit, I may be receiving much less than what I am otherwise receiving from my customers. So merely because on Make My Trip declares 8,000 and then gives a discount of 3,000, that is their concern. It cannot be considered as my declaration so as to impose that or to consider that tariff as a base to determine the applicability of GST rate on the restaurant service, which is provided by me. Second question is that there is a restaurant within my premises which is not owned by me but owned by someone else. It is rented out to someone else, and that third party is operating that restaurant. Whether it is also compelled to charge 5% if my declared tariff is less than 7,500, or do they have an option to charge 18%? Looking at the language of the notification, the ownership of the restaurant or the management of the restaurant is irrelevant. What is relevant is the place where it is situated. If the place where it is situated, the declared tariff is above 7,500, then only 18% applies, otherwise 5% applies. There can be a case to say that whether this 5% is mandatory. The notification uses the language that the option of 5% is mandatory where my declared tariff is less than 7,500. To my mind, that would not be the correct proposition in law. Notification stipulating the rate of 5% with the condition and mandating that rate has been issued in exercise of powers under 9.1, 11.1 and 15.5. If you see all these provisions, they do not give the power to the executive to make a entry granting an exemption from a regular rate of 18% and then mandating the taxpayer to follow that rate. 9.1 simply says you can prescribe the rate. That is 18. That is a general rate which has been prescribed. Then 11.1 says you can grant a full or partial exemption. By virtue of that, that 18 becomes 5 with certain condition. So to my mind, these sections do not empower the government to come out with a notification stipulating an exemption, a partial exemption, and asking the taxpayers to mandatorily follow that exemption. Already we have settled law, series of judgments in the excise era where they have said that if abatement is possible and if the party does not claim the abatement but chooses to pay tax on the entire value, you cannot deny the credit of inputs. In works contract, there was a situation in the pre-GST era. If you claim the abatement, then credit of input is not allowable because to the extent of value of goods, you are claiming an abatement. This was a case in the context of service tax, SV Jivani versus CC 35 STR 351, where the party did not claim the abatement and availed the credit on inputs. The tribunal said, once the tax has been paid on the entire value, then credit cannot be denied. Only where abatement would have been claimed, then the department would have been right in denying the credit on the input. So that principle would apply. We have Supreme Court decisions in the case of IPCL, etc., where the courts have said where more than 2 entries are possible, one can take an entry which is beneficial to the party. So to my mind, if 18% rate is what the restaurant operator wants to adopt, to my mind, they can adopt that rate with the availment of the credit.
The proposal number 22, I will summarize in 2-3 minutes only. See, basically, Finance Bill 2023 as a proposal that whatever the in-bond transfer takes place is otherwise falling into Schedule 3, GST is not payable. It is as good as high seas, you can say, for a comparison. So it's falling into Schedule 3, tax is not payable. But they say that we will treat this as a value of exempt supply. Now, if you look at the Schedule 3, the title says that these are the supplies which are not considered as a supply of goods or services. Therefore, it is outside the purview of GST law itself. So, whether something on which the government has no power to levy tax can be exempted. The identical situation was there before Supreme Court in case of Larsen and Tobro, 2015, 39 STR 913 Supreme Court. The Supreme Court was examining the issue basically of the taxability of the works contract prior to 1st June 2007. So Government of India came with the argument that in all along what we have done is we are only proposing to tax the services. We have issued the abatement notification to the extent it is pertaining to value of materials. So we are not taxing that. We have, by way of abatement, we have granted the exemption. Supreme Court says, first you show us whether you have a power to levy tax on this material. Under entry 97C, only you are empowered to tax on services, not on a goods. So something which you don't have a power to levy tax, you cannot exempt. First you show us the power that you can tax it, then you can grant exemption. But something on which you don't have a power to tax, you cannot grant the exemption. So this, you can, in a time to come, if you want to dispute this, that this cannot be considered as a value of exempt supply, because the proposal is to amend section 17(3). Similar is that they say that value of land and building, we will consider as a part of your exempt supply. But that is also falling into Schedule 3, that you can't take as a exempt supply. So this is a possible argument to say that this is not taxable. And so far as my another poser is concerned, because I am just, in 2 minutes I am summarizing, because ma'am says that you give the answers online. Because we are dealing with GST law, this law has a very bad history of dealing with online. There will be some technical glitch. You will get the answer only in the next tax conclave. So I am answering this. So poser number 26 is very small. When you are operating under the marginal scheme, then the rule 32(5) gives the valuation. It says that don't avail the input tax credit of the goods or services. The restriction is to the goods you supply. Suppose you purchase a second-hand car and you are selling that second-hand car, but you incur some expenditure on this, like painting, some repairing, etc. So you can avail the input tax credit of that. What the rule says that don't avail the credit of the goods you supply. So don't, if you pay tax on the second-hand car, that credit you cannot take. But other services credit you can take. There is a August 2022 judgment on this. Attica Gold, Karnataka Authority of Advance Ruling. I have not mentioned the citation, but Attica Gold is August 2022 judgment, which says that other input services credit is available. So far as my poses are concerned, I have completed.
So the next poser is related to eligibility of ITC on the rent amount. This is you know that port area, near to port area, Kandla port, you have seen the big tanks, and those are the storage tanks. Normally these lands owned by Kandla Port Trust, and they have given this plot to the service provider who has been obligated to construct tank over it and store liquid items on behalf of the importers. Now the department started inquiry and saying that whatever the lease rent you have paid to the Kandla port or any government authority, you are not eligible for ITC on the premise that by relying upon the section 17.5D, it says that goods or service are both received by taxable person for construction of immovable property on his own account, including where such goods or service both are used in the furtherance, in the course or furtherance of the business. So they say that lease service which has been used by you for construction of tank, which has been used for providing taxable output supply. What is taxable output supply? Is a store the imported goods on behalf of the importer for which you are charging some amount. And therefore they propose to deny this credit on this. Take an example like GIDC. GIDC provide land to the factory people. Factory person in turn construct this factory over it and ultimately use for manufacturing of the goods on which they normally pay GST. Now question arises whether the department can deny ITC on the lease, periodical lease paid to the GIDC. Answer is no according to me. And why I am saying that answer is no, they can't deny. That there is an explanation. What it says that services or goods which has been capitalized. If it has not been capitalized, it is permissible for the credit. That is one. Two, the intention of the legislature is that which the service or goods which has been used for construction of immovable property. Now for the interpretation of for means direct nexus. Take an example of architect services, interior services or cement or steel which has been used for construction. So those are directly for construction and that seems to be denied. I can still understand if the department proposes to deny the credit to the extent of lease rent paid to the extent of construction of this tank. Once this tank is constructed and it started operating it, then according to me the credit should not be denied. So the intention of the legislature is that to the extent once the construction is over, then whatever the credit whatever the payment GST paid on your input service or input, it is eligible for the credit.
Just I will also complete my posers to avoid technical glitch. So in fact, both the pending posers, partially it has been addressed by both the fellow speakers. So coming to question 25, it is in regard to GIDC, where the question is that if the first leasee assigns the right to the second leasee, it is a taxable transaction. So whether the second leasee can avail the input tax credit. I completely second the view taken by Hardik Bhai. I will only add two more points to it. One is fundamentally this is a transaction of lease. If you see section 105 of the Transfer of Property Act, a lease is a right to enjoy the possession of the property. What is restricted under 17.5D is a supply for construction of the immovable property. So both to my mind are fundamentally different. So I would go even to that extent to say that even during the construction phase of factory building, the credit would be admissible because whatever you are paying is for occupying the land. It is not for making a construction. Construction is completely an independent activity taken after the occupation of the land. This payment is not for constructing the building, it is for occupying the land. Second argument is that if the levy has been, if the collection of the tax at the end of the supplier is on the basis that it is a lease of property, then there is a settled proposition that that classification cannot be disputed at the recipient end by saying that this is for construction. If while collecting the GST, if they are saying that this is a lease and therefore it attracts GST, then at the end of recipient, a view cannot be taken by the department to say that it is not a lease. So that answers question 25, that credit would be available in case of this GIDC assignment of the leasehold rights. Last 29, this is in CSR. Jigar Bhai has already dealt with this issue. I would say that to my mind, prior to the amendment, the credit of CSR even in respect of goods would be admissible. Services he has already dealt with, that it is admissible. I would go to an extent to say that even in respect of goods, it would be admissible. There are a number of grounds for that. One of the ground is that this is for business Already we have decision of SL Propec where they have recognized in the pre-GST era that CSR expenditure is incurred to benefit all the stakeholders who are associated with the business. So it is certainly a business activity. Even under section 135, there is a requirement for the board of the company for whom CSR is mandatory to report in the director's report if there is a non-compliance and there are consequences on account of non-compliance. 17.5G, whether it applies to 17.5H, whether that applies to say this is a gift, to my mind this is not a gift, it is an obligation incurred by the company to comply with section 135. A gift is something which is undertaken out of love and affection, not out of an obligation mandated by law. So to my mind 17.5H should not apply if some items are purchased and given as a charity as part of CSR. Whether Schedule 1, Entry 1 applies permanent transfer or disposal. In case of CSR, let us say a company purchases medicines and distributes it because of COVID to various affected persons. Is it a transfer? To my mind, it is not a transfer. It is a distribution in charity. The word used in Schedule 1, Entry 1 is transfer or disposal of business assets. To my mind, this is not a transfer. And second, this is not a business asset at all. This is a medicine which is in any case in accounting standard also it is recognized at nil rate because this is for charity. This is not having any realizable value. A business asset is something defined under the accounting standards to have a realizable value. In this situation, it is not a business asset. Last poser part of CSR is that they have constructed a plant. Whether on that basis can credit be denied under 17.5D, saying that it is for construction of immovable property. If you see section 135 of the Companies Act, there is a mandate that if you create an immovable property as part of CSR, then that cannot be owned by that company. It has to be mandatorily owned by a section 8 company or a non-profit entity. So for me, it will never be a capital asset. It will never be capitalized in my books of accounts. So question of applying 17.5D would not arise and therefore that credit cannot be denied on that basis. Whether COVID-19 is an expenditure, in fact, in Ministry of Corporate Affairs has already issued a detailed circular saying that out of COVID, if you incur certain expenditure, it would be part of Schedule 8 of the Companies Act, which is the permissible domain of the expenditure which you can incur for complying with the CSR obligation. So to my mind, before the amendment is, as Jigar Bhai rightly said, it's a prospective amendment. So it should only apply from the date it comes into effect. Prior to that, credit in respect of CSR should be admissible.
Is in relates to the ITC avail in 1718 and at the time of filing of an annual return mismatch was found and reversal is also made. There is only 1 year audit is going on. Looking to the question, it seems there is only 1 year audit is going on and now the circular number 183 has been issued by the board. Now in that context, a reconciliation is made and it seems now that reversal which were done previously is now wrongly made the reversal by the taxpayer. Now the assessee, the superintendent or the assessing authority is going to charge interest as in the respective year you have wrongly availed the ITC and made the reversal subsequently. So poser is the taxpayer needs to pay interest on the wrong availment of an input tax credit. So far as this poser is concerned, you know that you have made the reversal subsequent to that year, but that assessing authority doesn't know that reversal has been done for the ITC availed by you in subsequent years. So what you need to know, what the taxpayer needs to do is, taxpayer needs to provide the reconciliation as per circular number 183 and he is not required to pay any interest. Even otherwise, if it found by the assessing authority that subsequently reversal has been done, then the whole reversal is not as per law because you are in a position to provide the reconciliation of the mismatch found between GSTR 1, GSTR 3B and GSTR 2A. So in any case, no need to pay any interest on the reversal made by the assessee. Then the last question is in context of the union budget, wherein clause 129 has been provided, substituted the provision of 180 days. What they done is, by clause 129, they have substituted the provision and changed the wording. Paid by along with interest is required to be reversed. Previously, what the wording are, that is required to be added into the output tax liability of the, if the payment is not made to the supplier within 180 days, then that ITC needs to be added into the liability of the respective claimant. Now they said that they made the corresponding provision in the rule, but the act has not been amended. So by clause 129 in the recent union budget, they made a provision that you need to reverse the input tax credit. Now the poser is, if that section has been substituted, then are we need to pay interest where there is a default by the recipient in making payment to the supplier after 180 days? So again, our stand, see previously what we argue is, there is no mechanism provided under the law, there is an impossible provision that we need not to file GSTR2, and therefore there is no express mechanism under the law, so we are not supposed to pay interest. Now after this amendment, and this amendment is going to be substituted in the provision, so originally it is required to be read as, this provision is from 1/7/2017, as it is going to be substituted. So mechanism now provided. So now the department asks us, now previously you are arguing that there is no mechanism, so you are not required to pay interest. Now we provide you the mechanism. Now you make a reversal and give us an interest. Can department take a stand? Again, we can argue that there is no failure on my part. So far as provision of 180 days failure is concerned, there should be the complete failure by the recipient to the supplier. Wherever there is a late payment after 180 days, after 180 days, then in that case, no need to pay interest according to my view. Thank you.
So last question, but I'll cover only in 2 seconds. It is similar to what Mr. Samir said in respect of liquidated damage charges. So my answer would remain the same. I'm not now saying further, except by saying 2 things. One, your agreement should clearly specify that it is only for this consideration, because how the agreement is drafted, that is most important in respect of the liquidated damages. And 2, there is also concept of unliquidated damages. And what is that unliquidated damages? That whatever the court has awarded, or whatever the by way of consent terms you enter into agreement later on, those would be called as the unliquidated damages. Nothing else I would like to add.
We thank all our dignitaries for the brainstorming and the insightful session. The loud round of applause clearly says that the session will be fruitful to each one present here. Let me take the privilege here to invite you all for a group photo. Dignitaries, kindly join the dais.